And again, everyone, welcome. Today we are going to use the morning session since on last Thursday and Friday, we actually traded live. And I know I went over a lot of details rather quickly because we were in trades executing. So today, I thought over the weekend, we would use today to actually go into detail for the strategies that I use in my playbook. Now, understanding, and I'll be repeating myself a lot, which is good because it reinforcement that the strategies I use, whether it be certain pattern setups, time frames, whether you trade them or not, the concepts will apply to how you trade or how you're attempting to trade or how you're attempting to create a playbook of trades, setups that work for you. So don't get all hung up on certain moving averages I might be using or certain time frames that I might be using. Be more concerned about the concept of what's behind why I'm using it, and I will try to explain. A lot of these strategies we have videos on in our equitiesetc.com trading room. We'll be playing those videos. They're short videos with me pausing them at key times where I feel that there's a good point that I need to make. And these videos I created, so it will be me on the videos. So we'll be taking a look at them, and those are videos that are in our day trading educational room. If we have time today, we will be discussing some swing trading strategy. So we should. So with that being said, I like to also mention that our equitiesetc.com trading room remains open for those who are trading today. And since I will be on mic teaching, I won't be trading live, but feel free to post your trades, post your charts, post the scans, your analysis to keep the flow of the room going. I'll also be checking the room, the chat, to see if there's any questions concerning the educational segment that I'm going over. And yes, Iris, I won't be able to trade with the donkeys today. But the folks on mic who are not members of our room can understand. I call all of you guys donkeys, but you donkeys are getting much better, I must say. Very good chat today in the pre-market room at some of those stocks that you guys are looking to trade or have traded. So with that said, let me set my screen up for what we're looking for today. Okay. So one of the things I want to discuss today is what exactly is in my playbook for day traders. We'll get to swing trading later. So what exactly strategies and setups am I using to trade in this marketplace and when? And as you can see in the right-hand side of my screen, I have a list of the strategies that are in my playbook for this market. And I keep using the term in this market, because when markets change, so do the strategies. So these strategies can be strategies that I use pre-market all the way up until the close. Some strategies work in certain parts of the day, others do not. All right. I'm always, though, very flexible and not rigid where everything needs to be black and white. So if a certain strategy that I like to play in the morning will appear as a setup in the afternoon, I will realize that it might not be back tested that strong, because I try to back test all my strategies to show that they are statistically profitable edgewise. So if I see a morning strategy in the afternoon, I won't discount it simply because it's a morning setup appearing in the afternoon, but I'll keep that in my back of my mind. All right. So I would consider it. So you can say that all of these strategies that we're going through will be good throughout the day. However, I'll let you know which time of the day they back test better in, and you can make note of that, and you'll see in some of the videos that we watch. I also want you to understand that this is not the holy grail, especially if you're not a member of the room and you're outside. I don't care what other gurus, what other trading rooms say, okay, what they promise. Um, the reality is this: you come into the equities, ETC, micro E futures trading room on your own, you stand a 1 in 10 chance of being successful at trading. 9 out of 10 individuals will fail at trading. I think we all know that. Those statistics are available. If you come into our room, maybe 3 out of 10 will succeed. 7 out of 10 will fail. I'm just being honest. I'm not going to promise you that everyone's going to get everything we do, because I'll be honest with you, most traders are simply lazy. They simply bounce around from strategy to strategy. But more importantly, what I think the real issue is not laziness. And the reason why they bounce around from strategy to strategy is because they do not give a strategy a chance. And they expect strategies to work 100% of the time. When in reality, when you back test strategies that are profitable, you might have a winning percent at best 60%, okay, over a long time period, which means that trade is going to fail 4 out of 10 times. And a lot of time, new traders will try a strategy or a concept. It will fail a few times to them. They'll lose some money, right? Because, so number one, they're probably not bankrolled correctly to trade. And then they discard it and they move on to something else. So they really never give it a chance to understand. And it's one of the reasons why, if you ever trade a new strategy or you form your own strategy to put in your playbook, when you're initially starting, you need to trade small dollar amounts and keep that in the back of your mind, because it's not just finding the setup that works. And we saw that on Thursday and Friday. You know, two people can trade the same setup. One will be profitable, one won't, because the most important part of the trade is the trade execution part when you're in the trade and how you manage the trade. And we're going to talk about that today, as we did earlier. So with that being said, let's just jump right into it. The first strategy I like to consider is what's called the S&B pre-market analysis strategy. And I'm going to put up a video shortly, short video, which I'll pause at key points, and the video is by myself. But let me explain to you where the concept of the S&B pre-market analysis strategy came from. All right. S&B Capital, Mike Bellafiore, who is the CEO of and founder and managing partner of S&B Capital, grew up in the same hometown as I did on Port Jefferson, Long Island. Okay. Mike and I see each other at trading conferences. So we still stay in touch. I wouldn't say we're best friends, but we do stay in touch. No question about that. And he has a very highly successful prop firm on Wall Street. They have strategies they use. They also use custom trade idea scans. They are not allowed, for proprietary reasons, to share their scans with anyone. So this is not directly from them. However, the concepts of the strategy is from them. All right. So these are concepts that S&B Capital actually uses, that traders use. All right. That I had the concepts and I was able to code a scan on my own and back test it. It's not exactly like what they use, but it's extremely close to how they use it. It's a very unique type of strategy. It does not back test super well because a lot of it involves quick trading, but you can also find some good long trending plays from this scan and strategy when they start appearing on different scans later in the day. So rather than me confusing people by that statement, we're going to take a look at the video, see what's including in this scan and why, and then I will pause it. We'll go over some examples, and then I'll ask the room if they have any questions on it. So save your questions until the end. Okay. So let me go get the video. Pull it over. and let's start it. Let me know if you can hear it. Can you hear the voice or not? If not, I'm gonna have to manually discuss it. So can someone confirm they hear the video audio or not? All right, and that's fine, okay? So we'll just go through the slides on this scan. And I thought that was gonna be the case, that it wasn't gonna allow us to listen to the video, which is fine. So let's take a look. You guys can see the first slide, am I correct? All right, Casey said when you share your screen, there's a button that says I can select. All right, let's see. Advanced sharing options. So you want me to stop sharing, then share again. All right, let's go with KC. Again, part of my stopping this screen share, for those of you not in our room, I am reading share. We're trying to get the audio going, so I apologize for the technical difficulties here. I'm not a Zoom expert. Stop sharing and share again. Okay, KC. Now I need to share audio. Where's that button? Just bear with me, guys. Share sound. All right.
Those
Let me know.
coded
Can you hear now, guys?
scripts to create this scan of ours. So the S&B
All right, let me
pre-market
start it from the
analysis,
beginning,
new
guys.
trade. I am giving a video presentation on how to play the SMB pre-market analysis scan that we Zoom screen share every trading day. Now, this is not a pre-market strategy to trade. Although you can trade it, we do not recommend new traders trade pre-market. But what this strategy is an intraday strategy. It works well for stocks that start getting alerted after the market opens based on symbols that actually alerted during the pre-market. Now, if you look on the Zoom screen share, okay, you can see right now I have the pre-market analysis scan up. It's where you see my cursor moving right now. Maybe I should see if I can get myself a better cursor that's easier to view. Okay. So let's get started. What is the S&B pre-market analysis scan and where does it come from? Many of you know we have a somewhat relationship with the folks at S&B Capital, but right off the bat, this is not one of their scans. Yes, the folks at S&B Capital, and S&B Capital is a Wall Street prop firm, one of the largest on Wall Street. They do use trade idea scans also. However, they code their own like we code our own, and it's proprietary. So this is not an exact replica of a S&B Capital pre-market scan that they use, because they do use something similar. They were kind enough during a training session video to allow us to see what filters they were using in this scan. And I'm not saying if they use those filters to this day or not, but let's just say that with their approval, we were able to use those coded scripts to create this scan of ours. So the SMB pre-market analysis scan alerts or starts alerting at 7 a.m. in the morning, and will alert throughout the day, but we only concern ourselves with the alerts pre-market. So that's from 7 a.m. to 9:30 a.m. Eastern time. So if you look at this scan, which is in the middle of the page, and this chart right next to it on the right is a 5-minute intraday chart, which we use for the SMB scan. Okay, what we're looking at, if you look at the text below the alerts, okay, we're looking for stocks that have gapped up 5% overnight or gapped down 5% overnight. So this is the data that is behind this scan. So we do not need to figure out any of this text filters. It's already built into the.
All right, guys, I'm stopping the video right here because I want to discuss why. Remember, I told you I want you to understand the concepts why, because this is going to help you with whatever trading strategies you're developing for yourself. So what we're looking for, why a 5% gap up or down overnight? Reason being, we're looking for stocks with other filters that we'll be going through that can do one of two things. One, they can continue up on a break of the pre-market high for a good long, or they can break down for a breakdown of the pre-market low for a possible good short. So we're looking for stocks that are already moving. That 5% is a key, because often I'll hear people say, well, how come this stock is not appearing on the SMB scan? It meets all the other filters. It's simply because it has not gapped up or down 5%. Okay, let's continue.
Scan that we Zoom screen share for you each day. So we're looking at stocks that are gapping up 5% or gapping down 5% overnight. This is a key. We're looking for stocks trading 10% of their volume, their daily average volume pre-market. Okay, so most of these we use a filter of 500,000 shares traded during the day. Okay, but we're looking for at least 5% of that 500,000, which is their daily average during the day, being traded, 10% of their daily volume being traded pre-market. So for instance, if a stock is trading 1 million shares daily average volume, the scan is picking up only those stocks that are trading 10% of that 100,000 shares pre-market. Okay. Also, and we'll explain in a couple of examples, we're looking for stocks during the pre-market that are consolidating. Not every alert on this scan above would be consolidating. So we're only looking for stocks that are consolidating. Any stock that is not consolidating, we do not look. And remember, no matter what scan you use, and in the case of ours during the day, we use the trade idea scans, all right? No scan alert should be played blindly without some sort of thesis behind it.
And again, I apologize. I'm going to be stopping a lot in these videos. Why the consolidation? This is a key concept to understand, regardless of the strategy that you're trading. Now, I can get all, complicated and tell you about buyers, sellers, market makers, and all that good stuff, but understand why consolidation is such a key. Consolidation, okay, sideways trading action is simply, in real basic terms, a battle is taking place. A battle is taking place between buyers and sellers, and who is going to win that battle? Is it going to be the buyers or is it going to be the sellers? Because after consolidation, are we going up or are we going down? And that is the key why in a lot of the strategies that we use, we talk about consolidation.
Now, we're going to set price alerts at the pre-market high, and we'll go through a few examples, and that will be along. But we're also going to set alerts at the pre-market low and we'll go short. So what we're saying, what we're looking for is stocks that are either going to break the pre-market high after consolidation, and then we go long, or we're looking for stocks that are going to break that consolidation below the pre-market low to go short. And then what is the catalyst behind the stock? Because if the stock has a catalyst, it tends to play stronger throughout the day versus just a quick scalp. A catalyst would be good, solid news, not fluff news, but good news. Okay, good earnings. Okay, we're not saying this is a must criteria, but with a good, solid catalyst behind the stock, you're going to find that it's not going to be a scalp type trade real quick. It's going to keep you out of danger, and you might find an all-day trend.
And again, what I'm really trying to stay here with this SMB scan or play, you're going to find two trades that are going to develop out of this. One is going to be a quick scalp. One's going to be the quick scalp when the stock breaks out of consolidation and breaks that pre-market high for a long or pre-market low for a short. Understanding that a lot of eyes and machines, and also those folks at S&B Capital who trade heavy size, are all looking at that same level and that same break. So often you will see a very quick scalp trade take place at that break of the high or that break of the low. Very quick type scalp trade. That's one type of trade. Usually those trades will happen when the stock does not have a super strong catalyst behind it. Okay, stocks that have a super strong catalyst behind it, meaning it wasn't pumped for the reason it's up or down 5%, but let's say positive earnings is being viewed on Wall Street. Okay, those are the type of trades that might be longer trend trades to take from this scan throughout the day. So that's very important to understand. At the break of the high or low, one of two things could happen. If it's a bullshit catalyst, right, that prompted the gap up or gap down, most likely it's going to be a scalp trade, and that's a very difficult trade for new traders to take. You might want to tend not to take it. However, if you feel it has a very strong catalyst behind it, like positive earnings, this is a type of stock that you might want to wait till after the madness of it breaking its high or low, the scalping portion settles down, and it starts trending all day in a direction. So I hope that makes sense. If it doesn't, when we're done with this video, ask me questions about it.
And we'll go through some of those examples. And then we're going to talk about, and I briefly mentioned it, the warnings and the dangers of playing alerts off this scan. One of them is just that. Some of these stocks move extremely quickly when they break the high or they break the low of pre-market, because let's face it, if we're looking at these stocks, and this is called an SMB pre-market analysis stock, and they have training videos that explain these filters that we were able to get from, there are a lot of folks, including the prop traders at the firm, that are probably playing this with a lot of money behind it. So some of these can tend to pop real quick and then come back down real quick. So you need to be careful, and we strongly encourage everyone to paper trade these setups first to get comfortable with how they move before you start risking real money. And that is the key. Don't just blindly listen to this training lesson I'm giving and jump right in. Get a feel for how these are moving. So let's take a couple of examples. Let's take an example of a slow grinding stock. And we like these, all right? We like these because they move slowly throughout the day. And the first one I have up is AVTR, okay? Now, if you look at AVTR, if you notice this little gray area, that's after hours yesterday, okay? Or Thursday. If you look at this tan area, that's the pre-market. So when this alerted pre-market, follow my cursor, notice how it consolidated pre-market. So what I did was set a price alert at the pre-market high and also the pre-market low. I had no idea if we were going long on this or we were going short on this, and we really don't care, okay? What happened at around this area where my cursor is, which is around 10 o'clock, it broke the pre-market high. When it broke the pre-market high, okay, then we had a decision to make. Did we want to enter this stock? And if we did, look at how it ran up the entire day. Such a beautiful, easy, smooth trade. Well, they're never easy. We all know that, okay? But such a low risk type trade. Okay. Now, what would our stop be? Well, if you use the 9 EMAs and the 20 SMAs, which you'll hear about us talking in the rooms constantly, and if you go to the training room, there's some documents on them, okay? We probably would have set it right below the 20 SMA, which you're seeing is the green. So that was a nice long. Now let me show you another long, which was a late day pop. Notice this wasn't a late day pop. This actually alerted at 10. But let's look at VUSI. Look at VUSI. Again, it's consolidating pre-market. We don't have to worry about all these filters down here. Is it 5% gap up? Is it trading 10% of the volume? Because all of that is caught when it alerts. All we need to concern ourselves with is it consolidating? And it was consolidating, going sideways pre-market, which is this 10 area again. We set the price alert at a high and we set the price alert at the low, okay? When it broke, notice, when it broke, which was later in the day around 3 p.m., look at the nice little pop it had. Nice little pop all the way into the close. And again, our stop would have been right below the 20 SMA. Had we gotten stopped out of that, it would have been a very low risk trade, would not have hurt us. Okay. Now let's take a look at a couple of shorts. Okay. Auto. Let's look at the pre-market. Consolidation. It's not the cleanest of consolidation, but it's consolidating. We set a price alert, which is the blue line right here at the pre-market low. We would also set one at the pre-market high. So let me put one right there too. Okay, so we would have two price alerts, those two blue lines, one at the high, one at the low. If it would have broke the high, we would have took it. But in this case, it went low. Now look how this was a quick pop. Look, you had to manage this trade carefully because this could have been a dangerous trade. It broke low. You get in. These are 5-minute candles, so you had 10 minutes to enjoy this trade. Okay? Now, look how quickly it dropped back. Look how quickly it dropped.
And I want to jump in here. This is the example of the stock that at the time did not have a strong catalyst. Although it did end up going down the entire day, this was the scalp play. Look how quickly, without a super strong catalyst behind it, that the stock dropped down and came right back up. All right, yes, you could have stood in it and it would have rode down the rest of the day, but this is one of those examples where you have to understand what's driving that gap up pre-market. Bullshit news or legit catalyst, because if you're going to play any trades, potential trades from this scan, it's going to dictate whether you're playing it as a very quick scalp, which we don't recommend new traders play, or if it's a legit catalyst, you're going to play it as a trend trade, which you saw in the previous examples. And for those who are new to our room, we will be going through some of those trend plays, so and where we play stops. So no worries there.
Drop back. Now, it wouldn't have stopped us out because our stop would have been above this case, the green line, the 20 SMA. But this is what I mean by you have to be careful, because some of these stocks will whip right back. Okay, so practice on the sim. But look at this. Let's say we took this trade, and let's say we weren't able to get out down here. That might have been a good thing, because look what happened the rest of the day for this stock. It trended down. And then the last example of a short, let's look at VVPR. Again, this is pre-market to 10, consolidation. It broke the pre-market low. We enter, boom. Look at this, down the entire day. and our stop would have been above the 20 SMA. So we would not have gotten stopped out of this until 3:30. Very nice. Now, obviously, I just gave you examples of clean plays. We wish every alert on this scan could be clean plays, okay? But they're not. So let's take a look at a couple. Look at QFIN. It alerts, but it was too choppy pre-market. I don't see consistent consolidation. Forget the volume, right? Because these candles could have had volumes. It was just too choppy to consider, regardless of what it did throughout the day. Let's look at BBN. Okay. BBN, same thing. Got all of its volume in one candle. REVG. Same thing. Now look at Shell. You might say to yourself, well, what about Shell? Shell's a prime example of a stock not consolidating pre-market. So if we were going to set pre-market highs and pre-market lows on this, look at the spread between the high and the pre-market low. Hopefully this is making sense. See, that's not consolidation. It's over $1 spread. So this would be one that we wouldn't even consider. So I'm just showing you examples that every alert on here is a type of an alert we would look at. So let's just repeat the ones that we would look at. ABTR. Why? Consolidation pre-market. Right there. Let's take a look at.
All right, guys, let's see. And the rest of that video is just me repeating myself and rambling on. So let's take a look if we would have played any SMB scans alerts from today. This is a current SMB analysis scan. Now, I only set price alerts pre-market. Doesn't mean I only trade in pre-market, meaning once the market opens, I actually shut this scan down. Because again, I'm looking for consolidation pre-market. All right. Now, FHN, I'm assuming just based on how FHN is trading, that's beautiful consolidation, isn't it? But someone take a look at it. I can almost guarantee you without even looking at news, maybe this is some sort of buyout. I have no idea. But let's look at INDO. I would not consider, okay, thank you, Dan. Yeah, you could, after a while, you tell immediately if a stock's a buyout or not. Now let's look at INDO. In your mind, do you consider that clean consolidation? What a key thing to do is, I don't want to give you hard rules to look at, but if you see $1 spread in a $13 stock, that is not clean consolidation to me. That is just too wide. So no, I would not consider IDNO. Let's look at run. And these are live SMB alerts, this pre-market. And again, guys, I'm looking pre-market, this area right here, this light 10 area before 9:30. Here's an example of one run. Let's see. Let's set a pre-market high. Let's set a pre-market low, because this is going to give us a good example. Number one, we always like to see candles close. So when we see a wick like that, we don't get too crazy. Okay. All right. We discount the wicks. So if you see the pre-market high and pre-market low consolidation, it really is consolidating for a $25 stock pre-market. And if you go all the way across, remember, right? Look at that nice little bump. Nice little bump on run, on Sun Run. So Sun Run is an example of how these things can pop. Let's look at BLDP. Pre-market, BLDP, same thing. All right. I think we all understand what I mean by setting a price alert at the high, price alert at the low. So I won't actually visually do it like I did the previous two example, but we have nice consolidation on BDP all the way across to where it pops. And you see how some of these can pop real quickly and move back real quickly. That's why understanding what the catalyst is a key. And take your profits. Now let's look at Nova. Nova is an example of a stock that did not consolidate pre-market, so we wouldn't even consider it. We don't care if it's going up, going down, right? We could play it as a trend play when the market opens like a 9 EMA, but we can discuss that later. We're talking about the SMB play, and no, it's not consolidating. So hopefully, guys, I think I'm coming across, but I'll ask the folks in chat. Do you guys who are listening to this now understand what drives the SMB analysis scan pre-market, even though we can trade it during the trading day? So is this making sense what we just went over? And number two, can you see how you can use this in other type of trading strategies and concepts? Do you understand why the breakout of consolidation can be so violently good if it's long, or violently bad if it's short? Because a lot of eyes are looking at that consolidation. See, that's a key concept. All right. That's why I tell people, please don't just learn a strategy black and white and check off the boxes. Understand what's driving it, because it's going to help you in other strategies. Now, when you see consolidation and you're ready to jump in, let's think back on Thursday or Friday. If you guys remember there was some trades in the afternoon that were consolidated midday, and you heard me say that I'm setting a limit order a few pennies above the consolidation. They were appearing on the long and strong scan. Remember I mentioned that? I rarely do that, but I do it when I see consolidation like that, because I know they're going to spike real quickly. And if I have my order a few pennies up, it's going to catch that spike. Because why I don't like to enter long or short in the consolidations, I like to enter once it breaks out of consolidation. But I also know that sometimes that consolidation could be real quick. Okay, good question. And I'm going to read the question that's appearing in the chat, because we do have some folks not in chat. The question was, it's making sense, just one question on the catalyst end. Strong earnings is a good catalyst, but sometimes it goes down with strong earnings. Is there a particular way to see that? Yes. First off, we don't try to figure out if earnings are good or bad. Good earnings or bad earnings is based on how Wall Street views it, how the market views it. So if the stock is going up or stock is going down, that is going to tell us how Wall Street is viewing earnings. Now, since we're setting a pre-market high alert and pre-market low alert, we're kind of catching that somewhat and can see. Now, remember, if we're playing a longer trend play based on a good catalyst, we don't necessarily have to enter immediately at the break. We can let that trend play out, and then the trend will tell us how Wall Street is viewing earnings, whether it's positive or negatives. We don't care if they're reporting EPS, future guidance. We're not smart enough to figure out how Wall Street's going to react to earnings. So we let the price action tell us. And this is a key point. When you're playing a longer trend play for the SMB scan, understand what you're looking for, right? The longer trend play, it's not the scalp trade that we talked about earlier, because there's some sort of catalyst behind it. So I hope that's making sense, Tim. Good. Now, before we move on to the Pesci and Algo blessing whack play, any other questions on the SMB capital scan? For those non-members of our room who are on, you can email me or direct message me at Beyond the Trades on Twitter, any questions, and I will get back to you. If any questions appear in our chat, I will be sure to verbalize them so you hear them. Okay, let's move on then. Okay, what is the Pesci Algo blessing whack play? Okay, what it is, it's both pre-market and during the day. There are two separate scans. short scans that were back tested by All Day Ray, unbelievably. These scans have back tests with a profit factor of not only in excess of 3, which consider risk reward ratio of 3 to 1, but in some cases 5, and in some cases 7. They have very strong plays. Like any other scan, regardless of how it's back tested, we do not blindly trade them. All right, so let's take a look at some of the setups and criteria that I personally like to use to trade these. Now, I know Ray has a video out there in the video room of how he likes to play them, which is a very good video. You should watch it. It makes sense, especially throughout the day on how he trades them. But it's a little bit different than how I trade it. So we'll discuss how I trade it. We're going to watch a short video on it, but it's important to understand we are looking for stocks that have gapped up. All right. There are about 37 coded filters Ray has. Everything from float size, okay, to institutionally shared held percents, to short float percents. I believe he even has range of day included in the scan. So we're not going to go through all 37, but we're going to go through what type of setups we're looking for and triggers to take these trades. All right. I personally love to use these trades pre-market, but they're also good scans for during the day. For me to use these scans pre-market, sometimes I find very nice early pre-market trades, especially on stocks that have gapped up. So let me go find the Pesci whack play. And it should be here. And again, I will stop it when needed.
Tell your story.
Hey guys, it's Steve from the equitiesetc.com/microefutures.com trading room community. I'm going to be going over today what I call a early pre-market, also early opening market, short play that has been working in the market of late. It comes from one of All Day Ray's back-tested, custom-coded trade idea scan called the Joe Pesci 2x scan. And again, I don't mean to interrupt myself. How funny is that? I'm interrupting myself. Although we'll be just mentioning the Pesci scan throughout this video, it also applies for the Algo Blessing scan. Called Joe Pesci because Joe Pesci is short, and the scan that Ray has coded is a short scan, scan that has been working extremely well, back test very, very well. If you're in the room, you've seen the back test actually in action with us. But what we've been noticing early pre-market as well as late pre-market into the open is a certain setup play
Breakout
has been much more favorable lately in this market of late. So we're going to discuss it a little bit, and we're going to use an example of a trade on this past Friday that we took pre-market on ALZN. So again, it alerts on the Joe Pesci scan. Okay, we're going to call this strategy the Pesci whack shorting scan or shorting play. So it's going to be called Pesci whack. Get it? Whack Pesci. And again, for those who are non-members of our trading room, and I should have explained this earlier, we do use trade idea scans. And most of our full-time traders in the room do use the trade idea scans and have the software, which we freely share the scans we use with everyone. However, for those who do not, we do Zoom screen share on Zoom daily. And you'll see that once I'm done with this educational course, you'll see on our screen share the actual scans that we use. So you don't necessarily have to have trade ideas to see what's alerting. And we use these scans to find us the setups to consider. Mafia. Ha ha ha, my bad jokes. But in any case, this is what we're looking for. The Joe Pesci scan finds stocks that are gapping up overnight. Follow my cursor here. What you will see, okay, in this tan area is the pre-market. The light brown area is pre-market. This grayish blue area is the previous days after hours. This white is actually the regular trading hours. So we're in the pre-market now. Stock is gapped up on news. Okay, so we want to take a look at what the news is, right? Normally, if a stock gaps up this much, all right, the folks that own this stock previously, okay, are probably looking to sell. Like if you own this stock from the day before, right? Say on Thursday, and this stock pops up so much pre-market, all right, from $2 up to almost $1 to $3.40. A lot of individuals are going to take advantage of that, especially if there's some sort of news. And then smart money is going to sell because retail traders are going to wake up. They're going to see that it's gapped up overnight, and retail traders, being dumb money, are going to continue buying it. They're going to want to get in on this big green candle, thinking it's going to keep going up.
Now that's a key point. All right. And I excuse those bombs going off. That is not the news channel coming from Ukraine. Those are my short scan alerts, their sound alerts. So I do apologize if you hear them throughout. But that was a key point that I just made. All right. Always understand you want to smart money, or smart even retail traders will sell into strength. If you own this stock or any stock, always from the day before, always ask yourself, on a gap up or gap down, what would I do if I owned this stock yesterday and I had shares in it? All right, because that will tell you a lot of times what smart money would do. So although retail traders for the stock that we're looking at on the screen might have saw that big gap up and say, I don't want to miss out, I'm going to buy. All right, which is what dumb money will do on these stocks that are moving up. Smart money who owned this stock from the day before is going to say, I don't need to buy it. I already made a shitload of money on that gap up. I'm going to start selling it, or at least start selling some of it to lock in profit.
Smart money realizes that. Smart money knows that they have liquidity to sell into. So the thesis is that smart money will sell into it. However, that doesn't always happen, as we know. A lot of the time, especially if low float, these stocks can spike up throughout the day. But we've been finding certain patterns where that's not the case. So the first pattern that we want to look at is we do look at the stock, because we tend not to want to play stocks that are lower than 20 million float size. And we see on this stock, right, when I look at the profile, it's around 38 million. Now, why don't we want to play stocks that are lower than 20 million? Because it doesn't take much to move the price, especially if we're looking at a pre-market or even early after the open, right? Pre-market, early open, low float stocks can pop up and down rather quickly. And it really doesn't give us an edge or give us an opportunity, right, to play this. So we see that it's above 20 million. So we like that. Now let's see what the news is, right? We see that the news.
Before we go on to the news section on that comment I just made, Mike Bellafiore, who I mentioned earlier, the founder and president of SMB Capital, says that we're only as good as the stocks we trade. Now, if you're going to trade junk stocks, you're going to get junk results. So you want to play stocks that are somewhat quality or somewhat has structure, that one can't be manipulated by price or by individuals or larger players. Low float stocks, although they can move up and down real nicely and real quickly, are very unpredictable, do not backtest well often, right? Sometimes they do, but often they do not, right? And you really have no edge in playing them. So do you sometimes miss out on big movers by limiting yourself to a certain float side and above? Absolutely. But in the long run, it's less stress, right? And it's more predictable price action for you on the chart structure.
News is that they had positive phase 1 trial. Now, we mentioned on a previous video I did, as well as we mentioned it in the equities ETC equities.com trading room. And yes, I'm throwing out the plug to the crew out there at equitiesetc.com/microefutures.com. We talk
Trust
about it
me,
all
they're
the
all
time, how
donkeys there.
phase one and phase two trials tend to give up their gains. And they tend to give up their gains, okay, simply because all a positive phase one or phase two trial means is they have to go to additional phase trials before the FDA can give them approval. So a phase one will have to go to a phase two, and if that's successful, a phase three, and then from phase three, the FDA can approve and they can go to market. So knowing that this is a positive phase one, we know that they have to run next a costly phase two trial. We also see here that they only have $13 million in cash left. A phase two trial can run anywhere from 20 million all the way up to 100 million. Don't quote me on it. Just think that it's expensive. So a lot of times what stocks will do, and it's usually higher price than this because this is only a $3 stock, that will use a price run up, and issue dilution, a cash raise to get the needed cash. And obviously if they issue a cash dilution, that will drop the stock price back down. So do I know that's going to happen with ALZN? Of course not. I don't. I'm using that as a general thesis that a lot of times that you will see a lot of phase one and phase two positive trials give up their gains. All right, simply because down the road, they're going to have to raise additional money through a cash dilution. And smart money knows that. Okay, so do we short every phase one, phase two trial? Absolutely not. But we look for those that are low on cash, also, and low on cash should be under 50 million, but low on cash, afloat above 20 million, that will have the following pattern that we're going to discuss. But let's first look at the news, right? We saw that the news was phase one. So that's checked, box is checked. We know that that's a catalyst that really doesn't justify this price increase. Although the stock could go higher throughout the day, no one's questioning that by no means. All right, we're talking about this period in time where you see my cursor. Okay, the pattern we're looking for is simple. The black here, follow my cursor, is VWAP. The orange is the 9 EMA, and the green is the 20 SMA. What we're looking for is after the first 5-minute candle, after the spike, this is a 5-minute chart, we want to see VWAP and the 9 EMA a good distance apart. You see where I'm moving my cursor? It's a good distance apart. We also want to see the 9 EMA and the 20 SMA a good distance apart.
Now, this is a big key concept. I see a lot of people make this mistake. You need for this play to work, and it's a highly successful play, especially early in the day, including the pre-market, is the separation of VWAP and the 9 EMA and the separation of the 9 EMA and the 20 SMA. That is a key, all right? If they are bunched together, I discount it. You will not get many trades early on from this strategy, but those that you do find, if you have patience to look for them, are profit-wise, as far as winning percentage, is extremely high compared to normal strategies. And that is probably one of the reasons why a back test with such a high profit factor on Pesci Scan. The mistake I see most people play is they'll play these three averages or two averages in VWAP bunched together when you need to see some sort of separation. Because as you will see when I continue the video, we do take some profits when it hits the 9 EMA. So we want it separate to realize that we're going to start selling off in case the 9 EMA is going to act as support for us, but we'll keep half shares in case the 9 EMA breaks and it drops all the way down to the 20 SMA.
Because eventually throughout the day, they will come together. But right now we're looking for that distance, that space between VWAP, 9 EMA, 9 EMA, 20 SMA. After that first candle, it's green, right? The second candle we're looking for to be red, followed by a breakdown under VWAP. So when we see a spike, goes above VWAP and then comes below it, we're looking to short it because a lot, and we wait for the candle to close.
right? We don't just take it if it just drops underneath VWAP. It's a 5-minute candle, so we wait for the 5-minute candle to close. Just like a baseball game doesn't end in the 4th inning, they have to play all 9 innings. If we're using a 5-minute candle, we wait for the 5-minute candle to close. When the 5-minute candle closes here and it shows us it wants to stay underneath VWAP, we take the short. With the thesis is the 9 EMA has been acting as a magnet in this market of late. So when it drops down to the 9 EMA, we're in our short. What we're looking for now is 9 EMA to act as support, okay, as resistance, excuse me, to our short. And at this time, it's perfectly okay to cover half your short to lock in profits and keep the other half if in case it wants to break it down to the 20 SMA. There's a lot of times it will pop back up. So we'll cover half our short. We'll move our stop now back to our entry price up here. So we're free rolling this trade. We can't lose. We locked in half, okay? Might not be a big game, but we locked in half. We move our stop back to our entry point now, all right? And then we wait for the stock to drop and see what it wants to do. Either we get stopped out. In this case, we didn't. It wound up breaking under the 9 EMA all the way to the 20 SMA. And this is the formation and style we're looking for. Now, we don't just play the pattern. A lot of people think you just play the pattern. This is the pattern we're looking for. Gap up, price above VWAP, break below VWAP, good distance to the 9 EMA, cover half at the 9 EMA, move your trail for the rest of the half to your entry point. So now you're free rolling it and hope that it drops down to the 20 SMA. And then you can get yourself out when it starts slowing down. Okay, that's the thesis. That's what the pattern looks like. Next, we want to make sure it's above 20 million, give or take. Okay, and then obviously we want to make sure that it's not totally legit news. If it's totally legit news, like positive earnings, and the market is reacting to the positive earnings, we wouldn't short it. We're looking for news that's either fluff or news like a phase 1, phase 2 trials that we know that it will be giving it up. So hopefully that makes sense. If not, we discuss these every day in our live trading desk room at equitiesetc.com.
All right, so I just wanted to add some comments about the Pesci and Iago Blessin scan. And it really has to do with how I opened up this session about you can use these patterns and these concepts on different time frames, as well as different times of the day, as well as possibly different strategies you're looking at. Be alert for this pattern setup. And then you don't blindly trade it, but you go through the criterias that will trigger this. Okay, and that is a big key. So you might be trading one of your own strategies and come across a chart that has a VWAP way above the 9 EMA and the 9 EMA way above the 20 SMA. And you might say to myself, that's an Algo Blessin Pesci strategy concept. Let me go take a look at it. And you might consider taking this trade throughout any portion of the day if the criteria holds up to it. So I don't want to make it seem like it has to be appearing
Breakout
on this backtested scan. Now, if it does appear on the backtested scan, it's stronger. It's stronger in the sense that those 37 other filters we mentioned about triggered. Okay, so that's a key. All right, so you keep that in the back of your mind. So hopefully that explains a good short strategy that we talked about. Now, one thing I do want you to take a look at here, because we're going to be talking about a 920 cross play in a little while. After we made this trade and got out of this trade, if you look right here where the arrow is, my cursor, that is a 9 EMA crossing underneath the 20 SMA, which is a strategy we're going to be talking about. And when that happened and triggered, look at how it went short even more. So this one stock, one setup gave us a Pesci Algo Blessing
strategy short. And then about an hour later, it gave us a 920 cross short. So that is something to keep a back of your mind when you're looking at charts and you get comfortable with setups that are working in this marketplace. Now that's a key, right? These are setups that are working in the current market conditions that we're in. It's very possible they will not be working in the future, months down the line. And we create different strategies based on back testing. And then obviously we share them within the room at equitiesetc.com. So I just wanted to repeat that. So let's now get rid of Pesci. Any questions on Pesci? Algo Blessing? I know a lot of these are actually trading live now. Thumbs up or down. How you guys doing in the live trading room today? Trading, you doing well? Next on our agenda is the famous 9 EMA long and short strategy. I know all of you think you understand the 9 EMA long short strategy. Unfortunately, for many, they execute it horribly, poorly. All right. It is so much more than just finding a stock riding up the 9 EMA or riding down the 9 EMA. And I see Dan is doing well trading live today. Good job, Dan, and all the others. And as mentioned before, why the 9 EMA? Why not the 8 EMA? Why not a different moving average or indicator? And the answer is it can be others. I just back tested successfully the 9 EMA, and I'm finding more and more stocks honoring the 9 EMA than other moving averages. And you have to understand what the process here. We're trying to find stocks that are trending up or down, usually that are owned percent-wise by more institutions, that they could possibly have an algorithm actually programmed to follow a certain moving averages. So not all stocks will move to the 9 EMA. Even most of these alerts might not be moving to the 9 EMA. What we try to do is find them. But it could be a different moving average. It could be the 20 SMA. And then we spot the 20 SMA being honored throughout the day. And then all of a sudden, we use the same concept we're about to discuss for the 9 EMA, but we just use the 20 EMA. So I hope I'm making sense here. So with that being said, all right, we have a document, not video, that we're going to discuss on the 9 EMA. So let me pull that up and let's discuss this a little bit. I bet you many in our trading room did not know that the 9 EMA scan only alerts to stocks that are up and down 2% or more on the day. Why is that? Well, one, it backtests to that, right? And probably why does it backtest well to that? We're looking for trending stocks. Position within range of the open, 98%. So we want to see stocks that are trending right away at the open. Now, the 9 EMA scans that we use do not alert until 15 minutes after the close because we want to see that trend being established. We have a relative volume of 2. We want to see stocks that are trading on twice its normal volume. So a lot of times I'll hear people say, Steve, is this a 9 EMA play? Look at this 9 EMA play. I might be, yes, it's trending up the 9 EMA, but in the back of my mind, I know it might not have any of these filters or criteria that we're going through that tend to be stronger 9 EMA plans. Time of day. Okay, we mentioned 20 minutes after the open. I have changed that to 15 minutes after the open. But this is a key. Distance from VWAP. We want it to be at least 2% distance from VWAP. Because as we know, a VWAP often acts like a magnet. Now, why does VWAP act like a magnet? Because a lot of firms trade to VWAP prices. We use a 5-minute intraday chart. Now, can you use other timeframes? Absolutely, yes. Just like you can use different EMAs or SMAs, right? You can use different timeframes. It just isn't back tested. So it doesn't mean it won't work. It very well will work. It's the same concepts. All right. It's just not back tested. So do not discard that. If you're using different time frames, you're using different moving averages or indicators, the same concepts apply, and this play could be very strong for you. For the back test, it's stronger on stocks priced between $2 and $69. So you might see stocks that are above $100 not appearing on the 9 EMA scan, but it does not mean they cannot be played. Earnings per share of between those two levels, that's just to filter out in the scan ETFs, right? ETFs don't have earnings per share. So we are looking just to filter out ETFs and those reverse type of funky instruments that are being 3-time leverages that are being traded. So what are we looking for when an alert scans? We want to see a history of a clean trend up the 9 EMA. And we'll go through some examples. We don't want to see stocks that are bouncing above the 9, below the 9, above the 9, below the line. We want to see stocks that are honoring and have shown, okay, that it wants to honor the 9 EMA. Stocks that are spiking way above the 9 EMA is not honoring the 9 EMA. Might be a good trade if you're long in it, but it's not a trend trade, right? So we're looking for clean riding up the 9 EMAs, and we prefer that it has tested the 9 as support several times. So if the stock alerts at 9:45, we do not jump blindly in. Even if it alerts at 10 o'clock, we don't blindly jump in. We ask ourselves, has it shown a history today of honoring the 9 EMA as support? We know that previously, the past 90 days, it has at time because it's appearing on this back-tested scan. But today, we want to see it showing a history today of it honoring the 9 EMA. Sometimes we find it will not honor the 9 EMA, but will honor the 20 SMA, which is on our screen. So we quickly ride this up to 20 SMA if it's showing a history today of honoring that moving averages. We prefer VWAP and a 20 SMA on a 5-minute chart to be close to the 9 EMA. Okay, so we prefer them to be somewhat bunched up if it's going to be a trend trade. And then you always, and this is the biggest mistake people make, check the volume at the time it is trending up or down and you want to enter. Check the volume bars on the 5-minute chart, and we'll take a look at some examples. Because if you're looking to go long a 9 EMA and the volume bars are trending down, that is not the time to enter it. And then, what is the current SPY doing, especially in the afternoon? And those of you who are on Zoom with me on Thursday and Friday know just how much stocks in this market of late, the crazy market of late, mid to late afternoon, they do exactly what the SPY is doing. Some charts actually mirror the SPY at that time, right? 3 out of 4 stocks will go in the same trend direction as the markets. And that fourth stock that may not be doing that is an alpha stock moving on its own with a super strong catalyst. Now, if it is moving on its own, does have a super strong catalyst, then yes, you can play it. But as a general rule, you want the SPY to be going in the same direction as your 9 EMA play, whether it be long or whether it be short. Do not enter a 9 EMA when it's pulled away. Wait for a pullback, okay? This is a 9 EMA back-tested scan. That 9 EMA is going to be a magnet and pull it back if it's going according to the back test and scan. So when a stock is pulling away from the 9 EMA, that is a good opportunity to take some profits, whether you sell half, move your stop to your entry, or get completely out.
I have often seen folks stay in only to lose money. Remember, the trade execution part is such a key here. All right, now I look at RSI, and if I see RSI is above 75, close to 80 or above, that kind of, and it's pulling away from the 9 EMA, that kind of tells me to get the hell out. If it's pulling away from the 9 EMA and RSI is still below 75, 70, I might sell half, lock in up profits and a win, keep half, since the RSI is not that high yet, just in case it still wants to keep spiking on me. I would move my stop to my entry price or even trail my stop in the money to guarantee that win that I already took by selling half shares. All right, then on the pullback, and again, we're going to look at some examples. On the pullback, you don't enter just because it pulled back and touched the 9 EMA. Wait to see if it's going to use the 9 EMA as support again. Because let me tell you, you want it to confirm that it's going to hold it 2-3 times, but anything after 4 or 5 times pulling back to the 9, it's eventually going to break. The more time support gets tested, the more likely percent-wise it will break. So you want to see a green candle after 5 minutes form at the 9 EMA on a pullback before you enter it. Biggest mistake I see folks make in the room is they enter too soon. They do not wait for that 5-minute candle to close green when it pulls back to the 9 EMA. There is no exact signal or entry trigger point, but above are excellent checkpoints to use. Why are there no exact signal or entry trigger points? Simply because moving averages are like fences. They move, they sway back and forth. Moving averages doesn't have a history of buying and selling taking place exactly at the moving averages because they're moving averages. They move. All right. They're not like certain points on a chart where buying and selling has taken place previously. All right. So there is no exact trigger point. The 9 EMA is a type of strategy that you will keep your stops right below the 9 EMA. So if you're entering right above the 9 EMA, your stop is a few pennies below the 9 EMA, which means when you lose, okay, you lose very, very small. You don't move stops because the whole thesis is ruined once it drops, and you wait for the 5-minute candle to close before you exit your trade, right? You wait until the 5-minute closes, all right? And then understand that even if you took a couple of small losses on the 9 EMAs, it only takes one trend up for several hours for you more than to make up for those very small losses you should be taking. So I just wanted to mention that. Let's take a look at the next page, and we've already discussed some of it. Entry should be right above the 9 EMA and not too far above it. You remain in the trade as long as the trend is riding up the 9 EMA. Your stop is always below the 9 EMA. You wait for that 5-minute candle to close. As we mentioned, use common sense. You wait until the 5-minute candle closes as a general rule. But if for whatever reason the stock is tanking, get the hell out. Use common sense. Rarely happens only because we don't trade low float junk stocks. And then the stocks that are better structured tend not to drop that quickly on you. When it starts to move or spike above the 9 EMA, a good thing, look to exit or sell all or some to lock in profits. We just discussed that. And then we talked about RSI, all right, being around 75, 80. Or a key point, if you know we're about to hit other resistance areas, EMAs, SMAs, high of the day, congestion on the daily chart. So even if we're intraday trading, we're looking on the daily chart, look left on the daily chart. If you see congestion, better way of saying consolidation, or you see it about to hit resistance at the 50 day moving average on the daily now, the 200-day moving average on the daily now, then you look to get out also. All right, so always look to where the next level of resistance is.
You can begin trailing your stop above the 9 EMA if you do not sell all of the shares after the spike, or if you prefer, just move your stop to your entry point. So now you're free rolling your stock. All right, good clues for possible all day trends. Stock has a strong catalyst on the day, such as legit news or earnings. All right, the above could indicate a large institutional trader is slowly building a position all day in the stock and is trying to get the best price. And one key is we have a scan that's called the 9 EMA plus earnings plus high institutional percent share ownerships. We have stocks that let us know that large institutions have more than 25% ownership in as combined in the stock that are appearing on a 9 EMA that has earnings, and we tend to find unbelievably good all day trends from that. Observations. I have all my success after lunch times with these scans, as I like to see the clean patterns develop. All right, and we pick them up off the long and strong scan. I rarely will play the first alerts that trigger until I see they have at least 30 minutes of trending the 9 EMA up, and they have tested it a few times. You will take many small losses, but just one all day right up the 9 EMA trade will make your day. Just keep your stops right below the 9 EMA and do not move them. Okay, you can discard that go-to pattern. That's pretty much just a long and strong type of pattern that we now have. And just because the stock is trending up the 9 EMA does not make it a 9 EMA play. Only those that get alerted on the right up or down 9 EMA scans are true 9 EMA plays. However, you can still play other stocks that are showing these same patterns and criterias. Just realize it doesn't have a 90-day history of following the 9 EMA, but you can still find excellent. For ride down the short 9 EMAs, you take every single one of these concepts and you just flip them. And here's an example of a 9 EMA play. It alerted at this blue mark. Okay, we see that it has been honoring the 9 EMA. I wouldn't enter it at 1300, 1 o'clock. I want to see it honoring the 9 EMA. So I might enter it at around 120, 130, because I see that it's honoring the 9 EMA. And then you have a nice trend up all day. And notice at no point did it close before the 9 EMA, under the 9 EMA. All right, and the 9 EMA for chart purposes here is orange. The 20 is a 20 SMA, and VWAP is black. Those of you who understand what a projectile strategy is, which we're going to talk about in a little bit, this is actually forming a good projectile play, and it's very possible this stock dropped. Now, I know it's after hours, but this stock actually dropped and ended up being a good short, but I don't want to get too far ahead of us right now. So is there any questions on the 9 EMA plays? Are there any good 9 EMAs being traded right now, live today on Monday? I obviously have not been looking at the scan alerts. I don't know if any folks in the room have. I'm just curious if any decent 9 EMA plays are out there so far this morning. The only other thing I want to mention about 9 EMA plays is they perform and they backtest horribly around lunchtime. So anytime approaching 11:30 all the way up to around 1:30, 1:45 Eastern time, they backtest horribly. Understand that you want to keep an eye on the volume bar. So let's look at Nova on my screen right now. Not that it's a 9 EMA play, but look at the volume bars. Although this stock is going up, volume is starting to go down. All right, if this was around 11:30 lunchtime hours, I'd be very, very leery about staying in the trade if I was in profits, only because there's a good chance that it will start pulling back. So again, 9 EMAs do not backtest well during the lunchtime hours, and they do not backtest well when these volume bars, and this is what I mean by volume bars, are trending down. You want to see the volume bars constant, and you want to see the volume bars going up. Okay, KC says she's actually in a 9 EMA play on BE. So let's take a look at BE. Okay, now BE is a stock that has tested the 9 EMA. 9 EMA is orange. Nice trade case, KC, by the way, is tested the 9 EMA a few times. And as you can see, it's starting to break away. It's getting a little high on RSI, right? I definitely at this $23 range might be looking to take some profits, right? I also look on the daily chart that it's at resistance of the 200-day moving average. If you're looking on my chart, daily chart here, which can act at resistance, and sometimes it takes a few pops to break through. So I wouldn't want to totally get out yet, although getting totally out right now to lock in profit's not bad because you can always get back in when it pulls back to the 9 EMA. But if you sold half, lock the
Breakout.
profit. And I'm not telling you, Casey, to do that. You can always still have half chance if it keeps wanting going. So nice trade, Casey, and good job. Anybody have any question on the 9 EMAs and how to execute them once in the trade? When to take profits, when not to take profits, why you don't move the stops, because if you move your stops, right, you just went against the thesis of the trade. And even if the trade ends up green for you, profitably for you, it's just pure luck. It's just pure luck. There's absolutely no skill involved. You just got lucky and you can't feel good about that. So these 9 EMA plays, or these trend trade plays, I should call them, are excellent for helping with emotional decisions because it takes the emotions out of these trades. Okay. Well, good question. Steve, when you enter, you want the volume going up, but does it matter if it's over or under the average volume? Apologies if that's a dumb question. Never a dumb question, Tim. Really, when it comes to trading, nothing's dumb. Nothing dumb at all. It's a very good question. All right. I do not, first of all, the 9 EMA scan has programmed, I believe, 1.5 relative to the volume. So the 9 EMA scan itself will only trigger to those that are trading above average volume at 1.5. So that's one. So to answer your question, if it's trending up, even if it's not appearing on the 9 EMA scan, it most likely is indeed trading above its daily average volume. I would look at that, but I can almost guarantee you, because remember, on a trend trade, you need consistent volume. And as far as volume is concerned, it's not that you always want to see the volume bars going up. You want to at least at a minimum see them consistent, meaning consistent, like consolidating. You just don't want to see them going down. And what the hell is that Vancouver Island thing? Vancouver Island, are you on Zoom? All right, when one stock has shown up on the SMB, not CMB, SMB scan and the 9 EMA ride up scan, does that add more volume due to consolidation in pre-market? First of all, now that's a good question, and the answer is yes. And let me explain why. Remember what we said about the SMB scan earlier. One of the trades, if it's not the scalp trade based on bullshit news, it is a trend trade from the SMB scan based on legit news. The 9 EMA scan often will pick that up. And when the 9 EMA picks up on a stock appearing on the SMB scan, it does hold more weight to me. Doesn't mean I blindly enter it. I consider everything that we just discussed, but in the back of my mind is a higher probability of trending for the rest of the day. Does that make sense, Iris? Good. All right, let's see plug. So you entered plug. Let's see plug. I want to take a look at plug. And for those of you not in the room, Iris is saying that she entered plug based on a 9 EMA. But let's take a look at this for a second, Iris. All right. if this tan is the pre-market, this is an excellent example. So let's look. What would we do pre-market when we see consolidation? We would set price alerts. Okay. Now notice how this went. We consolidated. All right. It didn't break above. It actually broke below the S&B pre-market low. So this actually was a short, all right, that turned into a long, all right. Now, that to me isn't necessarily a clean combo, meaning the S&B initially told you it was a short, now it's being picked up as long on a 9 EMA. So to be fair to yourself, Iris, I could understand why you entered it a little early, meaning this wasn't a powerful combo. You rather see the break above the SMB pre-market high and then the 9 EMA pick up on it. So both on the same side. Does that make sense? Am I making sense? Because this is an excellent example. So I would not have put SMB weight to it because the SMB initially said it was a short. Now, I'm not saying it cannot be an all day 9 EMA scan, but I wouldn't consider it an SMB scan play. So again, I add weight to when it appears as an SMB that breaks above, and then the 9 EMA triggers the same stock symbol in the same direction. Okay, no, I understand, but I also understand how this was more of a tricky play. Now, where you made your mistake, regardless if it appeared on the SMB and was in your direction, is you gotta let it test the 9 EMA for support a few times first. Just because historically it has, we want to see if it's honoring it today, because it very well might have honored VWAP, right? Or the 20 SMA. So you definitely want to see that it's honoring. Now, an example, when plug pulls back to the 9 EMA today, don't jump in early, wait to see if it gets a green candle, because plug might continue to be a good 9 EMA play today. I don't know what the news is on plug, if any news on plug. I haven't had a chance while I'm teaching to look at that. And this is why when we're learning these tradings or strategies, you want to trade small size, only because, you know, I use that analogy again. Inexperience, you need experience in playing them, right? It's like that brand new 16-year-old driver on a freeway is not going to be able to see everything like a 30-year driver on that same freeway that's just going to see everything at once. It's the same thing when you're playing these. And what I mentioned earlier, what most people do is they take a couple of losses because of their inexperience. And this isn't directed at you, Iris, by no means. It's for everyone in general. They'll take a couple of losses and they say, this strategy sucks, or this strategy is not for me, and they go move on to something else and not realize it's not the strategy that's misplaying it. And it's not that they suck as a trader, it's just lack of experience. That's all. An example, Iris sees the same exact play again tomorrow. Okay, she's going to know how to play it. She's going to discount the SMB alert because she saw that went short. She's not going to jump in right away. She's going to let it test it a few times first. So that's how you gain that experience. Okay, very good. I'm glad you brought that up. Sometimes posting trades that we lose on or we made mistakes on, throw your friggin' ego out the door. There's no ego in trading. We all screwed up. All right. I'll take your worst trades, anyone out there, and I'll multiply it by 5 times. I'll give you 5 examples where I screwed up the same trade worse than you have over the year. But you learn, and the only way to learn is by throwing out your losses, you know, to look at. You really don't learn from your wins. I shouldn't say you don't learn from the wins. Of course you learn from wins, but you understand what I mean, right? So let's see what's next on our agenda. Oh, the projectile to VWAP long and short strategy. I was so mad, guys, last Thursday and Friday we didn't have any of these examples appear, because these are like nice looking strategies that can move. So let's get right to the document instead of me trying to explain. Okay, projectile document. Let's see. There we go. I don't know, guys, has this been helpful? Or am I just repeating myself over and over again? What I'm trying to do is, I know most of you in the room understand the basics of these strategies. I'm trying to get behind it a little bit so you understand what drives the strategy or patterns and how to execute it once in the trade. So hopefully I'm coming across properly that way in it. So the projectile to VWAP strategy is a long and strong strategy. It's called AKA the puke strategy. It is a midday to late day strategy that backtests well during mid-afternoons to late afternoon. Can you play these setups at any time during the day? Yes, you can, but you'll find a lot of them will be fake outs. So you've got to understand that your chances of success are greater mid-afternoon to late afternoon on a projectile to VWAP strategy. So what is the basic thesis that we're looking for? We're looking for stocks that are trading up or down all morning for possible reverses to VWAP in late afternoon. Must be a clean, slow trend up the 9 EMA on a 5-minute intraday chart during the morning, or a slow ride down. We prefer, and I'm gonna go over this chart again. Let me just read through it. We prefer that the stock be appearing on a 9 EMA long or short backtested scan. Doesn't have to, but we prefer, but not always required as long as it's trend up or down. The 9 EMA is clean. Trade will be when the trend is broken with both the 9 EMA and the 20 SMA being breached with a target short or long to VWAP, depending which direction the morning trend was. And we'll show you some examples not to confuse you. So let me explain really what we're looking for. Okay, thank you, Tim and Iris. Let me explain what we're really looking for. We are looking for stocks that are, let's use a stock that is trending up all morning cleanly on a 9 EMA. Whether we're inning or not as a 9 EMA play. So it's appearing on the 9 EMA long scan, right? Trending up. And guess what? It trends up in the early afternoon too. This is a baby that's just going up today. All right. So if the 9 EMA is going up, you're also going to see that the 20 SMA is going to be running parallel with it, right below it. And we'll take a look at it. So the thesis is really this. We're looking for longs that towards the end of the day traders are going to start taking profits. That's it. And there's going to be a drop to VWAP. And if it's trending down all morning into the early afternoon, we're looking for day traders in those shorts that do not want to hold overnight, that are going to start covering. And it's going to puke or projectile up to VWAP. And we're going to get a nice long out of it. So the morning 9 EMA scan presents good afternoon projectile shorts for us. And the morning 9 EMA short scan presents possibly good projectile longs for us. For the projectile plays, mid to late afternoon, they are so SPY dependent. You want the market trending up if you're going long on a projectile play. You want the SPY market going down if you're taking a projectile short. Otherwise, you do not enter. And we'll take some examples. What to look for? We mentioned near the close, the better. We're looking for day traders looking to take profits or cover a short. Avoid going opposite directions of earnings plays. You can cross out earning plays because in this market of late, avoid going opposite direction of the market or SPY. Here's a key that I bet you didn't know for projectile plays. We like to see the float size between 25 million to 100 million. That's optimal. Can we play it if it's less or more? Definitely if it's more, but understand that the higher the float, the slower the move towards VWAP it's going to be, which means it's probably gonna be less of a move than in between that $2,500 million range. Do we prefer it lower than 25 million? I would go no lower than 20, only because it will become too swingy and spiky on you. And you can get some violent moves. So that's the optimal float. I wouldn't let above 100 million deter you from taking it. And I would not go below 20 million. Price, you wanted $2 and above. Now here's a key. I bet you didn't realize. We're looking for stocks that are up at least 5% on a day for a short to view up, or down 5% for a long to view up. Why 5%? We're looking for stocks where the day traders have made decent money already today. And we know they're going to be looking to capitalize and get out of their stock. So in essence, you get a squeeze at the end of the day towards VWAP. All right, the VWAP distance at least 2% away from the current price. When we look at what the pattern looks like, you'll understand what I mean by that. And then the moving averages, I mentioned for the projectiles, we do use the 9 EMA on and the 20 SMA on a 5-minute intraday chart as key trend lines. And low risk stops, like everything else of strategies in my playbook. Low risk stops. For longs, they will be right below the 9 EMA. For shorts, right above the 9 EMA. Let's take a look at some charts. All right. Let's start at 10 a.m. Don't jump ahead and cheat. At 10 a.m., let's say this appeared on a 9 EMA scan. Look at the trend up all day long. Nice. You could have took this long as a 9 EMA trade. Even if you didn't take it, even if it didn't appear on the 9 EMA scan, look at it trending up. The point of this is to find, so you guys understand the chart recognition pattern. Look how the 20 SMA is also somewhat going parallel up with the 9 EMA. And look how VWAP, which will always be lagging, is going up, but going up so small. Notice the difference between where the 9 EMA is, the 20 SMA is, and VWAP. That's at 2%. It could be 2% or more. That's why we mentioned that you don't really need to be calculating that. You can eyeball it and say, listen, our goal for this trade is to at least drop halfway to VWAP, in which case we would sell half our shares and then keep the other half all the way down to VWAP. Okay. So the trigger for us is the SPY, okay, also going down at the time. But when the 9, the price of the 9, not the trend line, although the trend line did cross under, but when the price drops below the 9 EMA and the 20 SMA, it doesn't have to cross. This did cross here, but it doesn't have to cross. Cross just makes it more powerful. But when the price drops below the 9 EMA and the 20 SMA, with those other criteria filters, right, we go short, right? And in this case, it blew right by VWAP. It also had a cross here, which we'll talk about later. So do you understand what the pattern looks like and what triggers it? What triggers it is price dropping below the 9 EMA, the 20 SMA, and the SPY going in your direction. Now here's an example too of a slower moving projectile short the VWAP because it had a higher float. We had trend up during the day, some consolidation, and then we had price break below the 9 EMA, the 20 SMA, and a slow trend to VWAP because of a higher float. Where in this earlier move, a lower float will tend to have quicker price action. Now, the flip side of that on losing trades, lower flow will move up a lot quicker and you'll tend to stop out a little bit more than a slow moving trade like this. Now you want to flip it and go long, same thing. We had a stock that went down on the day, consolidation, gave us the projectile pattern lookup, which is the 20 SMA and the 9 EMA together, VWAP above, and then it broke above. Boom. So hopefully that explains this. This is a very powerful looking setup when the SPY tanks late day. You get excellent projectile shorts on stocks that were moving up all day, and vice versa on stocks that are moving down on a day when the projectile tends to spike mid-afternoon. Prior to 2:30, a lot of these will be fake outs, right? Not all of them, but people will say, Steve, this has a projectile look, and it'd be 1 o'clock and I'll be looking at it. And I'm like, it does have a projectile look. It just performs a little bit better later day. It might not go all the way to VWAP. It might go a little bit and then fake out and come back up. I tend to only play projectile longs after 2:30 in the afternoon. Have I seen projectiles happen earlier than 2:30? Absolutely, yes. Have I seen projectiles happen on different time frames than the 5-minute intraday chart? Yes, I have. I prefer the 5. Have I seen it happen on different moving averages? Yes, it has. Again, I prefer the 9 and the 20 SMA. Make sense? Kabish, as we like to say over in my New York Italian neighborhood where I grew up. Kabish? Any questions on projectiles? And if we have any projectiles, I only plan on being on mic and Zoom in the morning. I will be Zoom screen sharing in the afternoon. However, should the SPY be spiking up or down mid to late afternoon, I will jump back on mic because I like to go through some actual live projectile trades with you guys since we didn't have the chance to do that. All right. So how would I trade execute this before we move on? Let's take a look at QGen. I like to take half profits once the stock is halfway to VWAP. I then move my stop to my entry, or I could trail it. So that guarantees me some profit. And then I look to see what it does on the other half shares that I still have, what it will do at VWAP. If this candle was green, meaning it was going to bounce up, I would exit it all. In this case, it didn't. It continued down. I would have kept my half shares until this green candle right there. So that's how we execute it. Notice I take profits halfway, move my stop to the entry or trail it in the money. And then I don't wait for it to go all the way to VWAP to start taking profits. All right, that takes care of that. What is next on our agenda? The 920 crossplay. Let me tell you something about the 920 crossplay. It can work on other moving averages, but the 920 cross is extremely powerful. It's a very quick move. It is when the 9 EMA crosses over the 20 SMA. It's a very powerful, quick move. You can say it could be a scalp move, which you can, but it also can be a good long trending trade. There are a lot of fake outs that happen on a 920, so you want to wait until the cross actually happens. You will see some criteria we look for. Most people don't know how to play crosses. They don't even know how to identify the cross. They think that just whenever the 9 EMA crosses over the 20 SMA, that is a cross. They don't take into factors such as where exactly is price at the time of that cross. So I think it's a video versus a document. So let's take a look at the video I did on 920 crosses. And again, as always, I will jump in and pause the video. It's not that long. I will jump in and take a look at it. We do not have any scans for 920 crosses. 920 cross, as you will see, is very difficult to code a scan to. However, if you can visually see these, they occur all the time in other strategies you might be looking at. You might be looking at a 9 EMA and see a cross, and bam, we just looked at a projectile short we just had that had a cross, and bam, you saw how powerful it was. So keep an eye for a 920 cross, not necessarily as a strategy to play alone, but in conjunction with other strategies. You can play it alone, but boy, is it powerful as a confirmation on other strategies you might be looking at. And they might be strategies that are completely different than my strategies in my playbook that we're discussing now. So let's take a look at how I describe the 920 crosses. Any questions, post them in chat, and I will pause this video when needed to explain some concepts.
Hello everyone, it's Steve again. On this lesson, we are going to speak about what I call a 920 cross. And what a 920 cross is really is a bearish or bullish signal. Now, it is not a strategy, which I will show you, in which when the cross occurs, that is an automatic entry. But what I have found in the strategies that we use, and specifically, let's say the strategies I use, which would be the 9 EMA long, 9 EMA short strategy off of the scans that we use, or the projectile long short strategy, or even the SMB strategy, what I look for are certain patterns that might say, stop, do not enter, or might be a certain cross pattern that says this is confirmation that this is a good entry to take. So what is a cross? A cross is when two moving averages cross over one another. Now, many people uses different moving averages for their crosses on different time frame charts. Okay, you might have heard of the debt cross on the daily chart. The debt cross meaning when the 50-day moving averages crosses underneath the 200-day moving average on the daily chart. That's a very bearish signal. And then the golden cross on the daily chart, in which the 50 moving average crosses over the 200-day moving average, and that is an extremely bullish type of setup. So what we do with these crosses now, we take it down into intraday charts. Now, if you use 1 minute, 3 minutes, or 5 minutes charts, it really doesn't matter because this is not a strategy. It is just a signal to let you know if it's a strong bullish entry or exit or bearish exit point in time. So let's go right to it and let's take a look at some crosses because visually it's the best way to learn. If you look on the screen share, you see I have a 5-minute chart. The orange trend line we are looking at is what's called the 9 EMA. Okay. The green trend line that you're looking at is called the 20 SMA. All right. I use the 9 EMA orange line and the 20 SMA green line for my crosses. Thus the name of this training lessons, the 920 cross. Okay, so let's take a look at rider systems. All right, what we are looking for in a cross, okay, are two things. One, we want to see the 9 EMA crossing over the 20 SMA. So follow the cursor, right? Where I'm circling, that's a cross. The 9 is going over the 20. We want to see that cross where there is at least a trend going up. And again, this is a bullish signal, and we'll go over bearish signals shortly. So again, we're looking for the cross, which you see, the 9 going over the 20. And then you have to look back. Well, is it trending? What you don't want to see is consolidation. All right. You want to see a defined trend. And usually going back 10, 15 minutes is good enough. And in this case, you see what, about 5 candles at 5 minutes apart. So it's about a 25-minute trend going up. So let's say you take a look at it. Look when this crossed. Look how it became a very, very nice bullish move. Okay. Now, again, do I blindly play these crosses as a strategy? No, but I will look on a trade that I am entering or even exiting. And if I see a cross is about to occur, I might wait to see what happens at the cross. So let's say this was appearing on any one of my scans that I was looking to play, and I saw this cross was about to happen. That would tell me that my thesis on the trade might be strong and that this is a good entry point. let's go through some more examples, because that's probably the easiest way to explain these than me just mentioning them. Now, this is an ugly chart, up and down, up and down, okay? We like to call this chart in our room the herky-jerky chart. And don't ask me to spell it. Now, this is both a combination of where we can look at a long and a short on the same intraday chart with bullish crosses and bearish crosses. So let's start with the bearish cross right here. If for whatever reason you were looking to play this ugly chart, if you notice the 9, which is the orange, moving underneath the 20, that is a decent bearish cross. Now, there is one thing we like to see, and we don't see it. When the cross occurs, do you see a candle? Is price at the exact point of the cross?
Now, guys, this is a very key point here. Two key points. One is going to be where exactly is priced the candle at the time of the cross. So pay attention. And the second part's going to be how many candles, 5-minute candles, do we want to see trend-wise before we consider taking the cross? So pay attention to the upcoming parts.
And the answer is no. Now, that doesn't mean this wouldn't be bearish, because obviously it was bearish when it crossed. But
Oh, looks like we had a meteor play there. Apologize to that, folks.
hello, everyone. It's
Oh, we got 5 minutes, I think.
right here. If for whatever reason you were looking to play this ugly chart, if you notice the 9, which is the orange, moving underneath the 20, that is a decent bearish cross. Now, there is one thing we like to see, and we don't see it. When the cross occurs, do you see a candle? Is price at the exact point of the cross? And the answer is no. Now, that doesn't mean this wouldn't be bearish, because obviously it was bearish when it crossed. But let's go back to our first example, which was Rider. Look when it crossed. Follow my cursor. Look when it crossed. It crossed right at price. So when you see a cross right at price, meaning the candle right at price, that is a much stronger cross to consider. And we'll go through some more examples of these. But let's get back to that ugly chart fate. Because as ugly as it was, it gave us some good crosses. Now, if you look after the bearish cross was done, it crossed over and actually gapped up over a cross. Look when it crossed right here. Now, it wasn't exactly on price like we mentioned, but look how the 9 crossed over the 20 SMA, the green line. It was trending up and it popped. Okay, let's take a look at another short example, FND. So what am I looking for? Let's say, look at this. This was a 9 EMA. Let's say this was a 9 EMA play. Nice, right? We're playing this going long. Very nice, right? Price crosses under, okay? And then we might say to ourselves, well, maybe this is going to turn into a projectile short. And when I use the term projectile short, there are training documents in the strategy vault in our rooms that you can take a look at that strategy. But let's say we were looking to take this as a projectile short. And then we came across and said to ourselves, whoa, I see a cross about to happen at this time frame. Is it trending down? Yes, it is, right? For about 20 minutes, right? 4 candles at least. Is price at the cross, right? Is a candle at the cross? Price is at the cross. So when this cross occurred, okay, it confirms our short that we were going to take on our projectile short strategy. And boom, we enter it short. So does that make sense how we like to use it as a confirmation? Now, if the cross wasn't there, it doesn't mean we wouldn't go into our existing strategy short Anyway, it's just a good confirmation. Okay. And then let's even on this take a mini long look right here. The 9 EMA crosses over the 20 and it was a small little pop. So see how powerful these 9/20 crosses are? Again, the 9 EMA, orange trend line, crosses underneath the 20 SMA, boom, bearish. When the 9 crosses above the 20 SMA, bullish. Okay? Let's take another look. AVTR. AVTR. Okay? Trying to see where there was a good cross on AVTR. Right? And it was an excellent trend up. And I'll be honest with you, I don't know why we even have this, because this is just a beautiful right up the 9 EMA type. Now you could say right here, this isn't a good example. You could say right here, when it crossed under the 9 EMA, crossed under the 20, it became short. But it is a good example of a cross that's not that powerful, so we can explain that. Okay, here we ride up along the 9 EMA, which is one of our strategies in the trading vault, so please review that. Then we notice it's crossing underneath, but look, there's no trend, right? It's been trending up. We don't have that trend down, right? So it's a very weak cross, and thus was a very weak move. So does that make sense? Let's look at.
And that's a key point on this example. And it's probably why I had it as an example, was the fact that this was a very weak cross, that it didn't really trend down 3 5-minute bars. So to look at where the price or cross happened, it was really consolidating and not trending down, just trending down a little bit. And since it was, I call it a mini cross, meaning it wasn't a strong cross trend wise, you want to see the 9 trending down a little bit more. Notice it wasn't that powerful of a move. It wasn't that powerful of a cross. So that's a key point to also understand. I would not play a cross like this. I need to see it like the previous examples, where it's a good trend down for a short or a good trend up for a long.
Well. Okay, now, well, here's an example. We have a trend going up, going back about 15-20 minutes. We have the 9 EMA, which is the orange trend line, crossing over the 20 EMA SMA. Again, it's 9 EMA, 20 SMA. Okay, so the 9 EMA moving average crossing over the 20 SMA moving average. Is price at the cross? Yes, price is at the cross. I know that by the candle. And boom, look at the little pop-up. Look at the little pop-up. And then we get another bullish cross. And boy, what a run-up it had. Right here, look. Right here, where I'm circling. We have a trend for about 20 minutes. We have the 9 crossing over the 20 SMA. And look at the trend up. That's a good example. Let's do one more. And then I'll recap this. If you want to take notes, I'll speak slowly on the recap. All right, now here is what we'll call not a good cross. So we're looking at PRNB. And the area in question is right here. Okay, we do see a 9 crosses underneath the 20. So the 9, the orange, crossing underneath the green, 9 EMA, the green is a 20 SMA. We see it crossing under, okay? However, it's not a strong trend. And when you don't have a strong trend, meaning when you have consolidations, then it crosses over, you get a very weak move. So in recap, okay, if you want to write this down, or you can DM me, or we can have a one-on-one lesson on these crosses. What we are looking for is the 9 EMA crossing below the 20 SMA, trending at least 15-20 minutes, so look at the candles, crossing at where price is at, the candle, and if the 9 crosses underneath the 20, it's a bearish move. And then you flip it. If the 9 EMA is trending up and it crosses over the 20 SMA, it's a very bullish move. If there is no trend for 10, 15, 20 minutes and it's been consolidating, if the cross occurs, it's a non-factor. So I'm hoping that makes sense. Okay. If you need any additional information to identify crosses, you let me know. During the week in the rooms, we'll start pointing them out. I believe we have been pointing them out. And again, it's not a strategy, although a lot of people will play them as strategies because they are very, very solid plays. Okay. I use the 5-minute chart, but I've noticed these crosses also work on other time frame charts. So again, if you have any questions, you feel free to contact me. And again,
So that will be the crosses, and I think many of you do realize the importance and the powerful of the crosses. Just keep in mind, you're looking for price, that candle to be hopefully at the intersection of the cross, and you want to see a trend of at least 3 or 4 5-minute candles, meaning at least trending the 9 in a certain direction, just the 9, because that's the one that's going to trigger it above the 20 SMA or below the 20 SMA. You like to see the 9 trending up or down at least for 20 minutes, 15, 20 minutes. So keep that in the back of your mind. If you have any questions on the 920 crosses, please post them in the live trading room. I see you guys are actively trading this morning, Monday, February 28th. In the room, it looks like some of these have some nice trades. So it looks like there's some good price action taking place. So feel free, give me a thumbs up or down if you guys are doing good. Thank you for those who are posting in our chat room, keeping it active. Really appreciate you guys. And again, anyone have a question on 920s, let me know, because we're about to move on to the bunched up twigs moving average strategy. I know that sounds really crazy, but let's for a second talk about why I named it the bunched up moving average twig strategy. Okay, I think the first thing we want to understand is what happens with a twig, right? When you as a person tries to snap one twig. Okay, hold on. Before I move on to the twig strategy, I do see a question from KC in chat. So let me repeat it and answer it, and then we'll move on to this next strategy. Steve, when you frequently talk about, don't forget to look at the 50 and 200 EMAs. So are there certain strategies you add the 50 and 200 50 and 200 EMAs to, in addition to the 920? So what Casey is asking is, Stephen, you often mentioned resistance areas or support areas at the 50 and the 200-day moving averages. Casey, those are on the daily charts, right? When we're talking about the 9 EMA and the 20 SMA, the 9 EMA and 20 SMA is on the intraday 5-minute chart. On the daily chart, and when we go over our swing trading strategies, won't be today because this is going a little bit longer, but we'll have a separate training session on our swing trading strategies. You will notice on the daily chart different moving averages, and 2 key moving averages are the 50 and the 200. So you always want to look at your daily chart, the 50, 200, to see if there's any sort of resistance and support areas that you might be coming up to, even on a day trade. I don't want to make that too confusing, but it's just something to keep in the back of your mind. So why do we talk about the moving average strategy as a twig strategy? Well, I like to give a visual or an analogy. If you have one twig, and think of a twig as a moving average or VWAP or whatever indicator you might use. So you just have one, and that one is support or resistance. One twig is really easy to snap and break. It's not that difficult. But when you start putting a bunch of twigs together, and again, the analogy, a bunch of moving averages and VWAP together, and you try to snap it, those twigs, those bunched up twigs, it's much more difficult. And that same analogy holds true when you have bunched up moving averages. It's much more difficult to break that support or break that resistance when you have several bunched up together. So keep that in the back of your mind as I'm going to start this video. And again, I will pause it if anyone has questions, and I will pause it for key concepts that I just want to emphasize. All right, this is the moving averages bunched up twig strategy.
Hello, everyone. This is Steve, and how are you doing today, this fine weekend? At least it's the weekend for me, as I am recording this on a Saturday morning. I just wanted to have an opportunity today to discuss a strategy that I've been finding not only backtests well, but also has been pretty effective in the type of market conditions that we are under right now. And that's called the triple moving averages strategy. But before I go into detail on a strategy, I do want to discuss how I'm introducing strategies into the channel room, the training vaults that we do have. I think one of the keys is understanding what the market conditions are in, which strategies are back testing well for the current market conditions, and those are the strategies that typically I will use. Now, I bring this up for a reason, because I will be doing a future video, and that future video will be on creating a playbook for you as a trader. And in that playbook, understanding the need to have if-then statements prior to every trade that you make, with the understanding that you do not trade individual stocks, you trade individual strategies that a specific stock might be showing you to be happening via price action. And that is a key. That will be a separate video. But it does lead us into why in my playbook, I do not have the entire playbook out there in the equities ETC room in the trading vault. And the reason being is my playbook is quite comprehensive because I've been trading for many years. The thing to understand is we will be introducing more and more strategies that are back tested, and that is a key. Okay, you don't just create a strategy because you read someone on Twitter using it something, or you see a cup and handle pattern. That is not a strategy. A strategy is something that you back test for current market conditions to see if it gives you a statistical edge, at least for the prior 30, 60, 90 days. All right, so with that in mind, a triple moving average strategy that we will be discussing, let's think of it as this analogy. I'll give you my analogy, and then I'll give you Brian Shannon's analogy. My analogy is think of moving averages as twigs, okay? And you probably heard me say this before if you're in the room, all right? If you have one twig, it is very easy to snap one twig. It doesn't take much. So the example for trading would be if you only were looking at one moving average and price hits that one moving average, it's a lot easier for price to either fall under or fall above that one moving average. Where if you have several moving averages, think of it as multiple twigs together in your hand. Now it becomes a little bit more difficult to snap those twigs because you have multiple. It's just simply harder. And the same thing with price action. As you have more moving averages, including VWAP, if you like, it becomes a lot more difficult for price to break through multiple moving averages. And if it does, you're definitely probably at the start of a new trend. Brian Shannon, as he stated perfectly on the Confessions of a Market Maker podcast he did with JJ and Ray a few weeks ago, said it this way best: regardless of the moving averages that you use, and everyone uses different moving averages, and there is not one magic or magic set of moving averages to use. The key magic is, have the moving averages that you use, have they back tested well? Or are you just plucking them out of the air, or because of your favorite Twitter trader who you have no idea if they're profitable or not is using? All right. If your moving averages back test well, it doesn't matter what moving averages you use. All right. You'll see which moving averages I use, and that could change based on back testing. But in the market conditions we're in right now, these seem to fit my trading style. But what Brian says, all right, back to his analogy, and it's really not an analogy, is if you have several moving averages all together, you have several sets of eyes looking at those moving averages. So you have all of the 50-day moving average folks looking at price at that inflection point.
And that's a key point, what Brian Shannon points out. When you have more than one moving average, VWAP, or whatever indicator you might be using, more than one, that's more eyeballs that are looking at that area to either buy or sell. And if there's more eyeballs looking at it, there's probably more algorithms and machines looking at it. There's going to be a lot more buying and selling happening eventually at that location, usually before some sort of breakout with buyers taking control or sellers taking control. So keep that in the back of your mind. That is what Brian means by more eyeballs looking at those levels when there's more than one moving average where price is at.
Point. You might have all the VWAP folks looking at the price point at that same location. The 9 EMAs, you have all the 9 EMA guys looking at price point. You have more people looking at the price action at that price point. So it's an excellent point that he made. So the triple moving averages strategy kind of fits into my twig analogy, and it definitely fits into what Brian just described as I paraphrase. So let's look at, okay, the moving averages and the EMAs and SMA trend lines to use. Okay, I know it says EMA trend lines, but it's EMA and SMA trend lines. The EMA meaning the 9 EMA is your driver and all that. That's why.
Now, when we're looking at this chart, you notice I do have the 50 SMA up there. You will notice, or I have noticed, that in lieu of the 50 SMA, you can also use VWAP. Not that they're at the same location, but the same theory of them being bunched together holds up. So for those of you who like to use the 50 SMA on your daily intraday chart, and some of you do, okay, you can use the 50 SMA. Now, I personally do not use the 50 SMA on my chart. I use VWAP, the 9 EMA, and the 20 SMA on my 5-minute intraday chart. Again, we are not talking daily chart. We are talking intraday chart. This is an intraday day trading strategy, but it is okay to use the 50. And if the 50 was bunched up with the 9 and 20, it would make this strategy even more powerful. So the question might be, well, Steve, then why don't you include the 50 on your charts? I like to keep my charts clean. So I have the 9 to 20 and VWAP on it. I'd rather not have a fourth. That's the only reason why. If you're brand new and you want to play this strategy, and it is a good strategy, you might want to include the 50 SMA also.
It takes more priority. But let's look at this slide. This slide is going to be very confusing the first few times you look at it. And that's okay, because we're going to go to slides 4 and 5, which are going to give you visual examples of actual trades on Friday via a 5-minute intraday chart. And again, this is a day trading strategy, so we do use the 5-minute intraday chart. We do not use 1-minute charts. If anyone is teaching you, especially if you're a new trader, to use 1-minute charts, okay, as your primary source, okay, they are teaching you wrong. No ands, ifs, or buts about that. More advanced traders, I possibly can understand. I only use 1-minute charts, okay, if I'm at a point where I'm deciding when, meaning within seconds or minutes, if I'm going to exit a trade. And I'll use the 1 minute to see if there's a very quick movement happening that says, okay, get out now. Okay, but my primary use of is the 5-minute intraday charts, as a lot of folks. Okay, the longer time frame you use, 5 minutes, 15 minutes, 30 minutes,
okay, the more consistent the patterns are going to be, the easier it will make your trading. Okay, the stocks, the price actions tend to be more historically true to form. All right, so let's look at this slide. Okay, the moving averages we use are the 9 EMA, the 20 SMA, and the 50 SMA. When the 50 SMA is below both the 9 and the 20, we consider the trend to be up. So let's quickly go to slide 5. Okay, the 50-day moving average is the maroon. So that first bullet point we just looked at is if the maroon 50-day moving average is below both the 9, which is the orange, and the 20, which is the green, then you are in.
And again, you can substitute if you do not have the 50-day moving average on your chart. You can substitute VWAP with it. I will be honest with you though, using the 50 SMA is a much more confirming basis for this strategy. But as you will see later on, really we're looking for consolidation, and VWAP can serve that same purpose. But again, if you're more experienced, I could see using it that way. But for beginners or you're new to this strategy, you might want to consider adding the 50 SMA.
In an uptrend. If the 50, look here, the 50 is above both the 9 and the 20, you are in a downtrend, meaning a short. Okay. When the indicator is above both the short-term moving averages, we will consider the longer-term trend to be down. And that was the short example we just looked at. Now, we also want to see the 20 below the 9 and above the 50 for a long. So we want to see the 20, okay, below the 9. The 20 is where my cursor is, the green, which it is. Below the 9-day moving average, but above the 50. So in between, okay, which it is. And that will be your long. The 20 should be above the 9 and below the 50 for a short. So here, let's look at this short example. Again, the 20 is in between. It's above the 9, but below the 50, and that's your cue for a short. Okay, the 9 EMA crossing over the 20 while already above the 50 is an uptrend, and you're looking for a long. And we'll look at that example shortly. And the last bullet point, if it crosses below the 20 while already below the 50, that is a downtrend looking for a short trade. And we'll look at a visual example shortly on this. So I know this slide can seem confusing. It's a lot easier to look at the chart, and I agree. But if you can visualize in your brain what these setups look like based on these bullet points, what will happen is you'll be able to much more quickly pick up these chart patterns, okay, throughout the day, and to see them forming sometimes before they even form, meaning you can anticipate that this type of strategy play will be happening possibly later in the day.
Now, one of the key about those patterns forming is a lot of times these bunched up moving averages strategies do not occur until consolidation takes place, usually around the lunchtime to early afternoon. So you might be seeing very strong trend plays in either direction in the morning that are not lining up just yet for a possible consolidation, bunched up moving average play. But you're kind of sensing that if the stock slows down during the slower lunchtime periods, that might be the case once we get out of lunch into the early to mid afternoon or even late afternoon.
So that's what I mean by anticipating these being possible good plays. Now, what's really good is we have the long and strong afternoon scan and the short and weak afternoon scan that alerts us to these type of setups so we don't have to find them ourselves.
And you see that all the time with Ray, myself, and others in the rooms where we're spotting specific strategies hours before they're setting up. They might not be ready now, but we see the pattern forming. And that is based, okay, on understanding what drives the pattern. So please take the time to memorize and study this slide. Okay. Trading with the 3 moving averages, the strategy. When the indicators are jumbled together, consider the market to be in the trading range. When the indicators are jumbled together, consider the market to be in the trading range. The price action is trading in that jumbled area. Okay, when the faster, aka smaller moving averages, start to pull away from the others, consider momentum entering the market. And momentum is probably equal to volume. So let me repeat that. When the faster of the moving averages, the smaller, so the 9, okay, starts pulling away from the others, consider momentum entering the market. Seeing the 9 and the 20 EMAs crossing and separating, we are looking at a trending market. So when you see a 9 EMA crossing over a 20 SMA, okay, so 9 going above the 20, that's a trending long market. When you see the 9 going underneath the 20, okay, that's a trending south. Now, the trend is the key word. It's not consolidation. You can see anything during consolidation. Consolidation is a trading range. When we're talking about these crosses, we're talking about a downtrend or an uptrend before the cross actually happens. I refer you to the training video we have in the day trading room called the 920 crosses, which clearly explains how to find crosses and that a cross is not just 2 lines making a cross. There's more behind it, and you need to understand that. So please watch that video. It's called the 920 cross in the trading strategy room. When all the averages line up, a strong trend is beginning to form. And what I mean by all the averages line up, I refer you back to slide number 2. So let's take a look at some examples. Okay, the first example we're going to look at, okay, was from Friday on Snap, and it's an example of a very strong long. Okay, first thing we want our eyes to look at, and I'll repeat, the first thing we want our eyes to look at is where is the 50-day moving average? Because remember on that slide, if the 50-day moving average is below the other 2, it's a long trend. If the 50-day moving average is above the 2, it's a possible short trend. And I use the term possible because nothing ever in trading is black and white, as you're probably all starting to understand that. So in this case, what catches my eyes is the fact that the maroon, the 50-day moving averages, is indeed below. I also want to see the 20-day moving averages in between, right? Below the 9, but above the 50. It's easier to think of it in between. Is it in between? Yes. So when the 9 crosses over, both the 50 and the 20, where the 20 is in between, meaning the 20 is above the 50, that's a signal to possibly go long. And you can use your 9 EMA as your stop. So you ride up the 9 EMA. And what a beautiful, beautiful trade Snap was. So you get in, you use the 9, if it falls below the 9 as your stop, if you like, and it's low risk, and you have a beautiful trend up. And it's all because, look at this, the 50, the 20, the 9. So let's take a look at a short that also happened on Friday, okay? It doesn't have to be perfectly clean charts like this. I mean, this is a perfect example, right? But real life, we don't find too many that are so perfect like this. So let's look at one that isn't so perfect. A stock that opened up extremely choppy, but then look what happens, okay? It started to trend down, but we don't have an entry here. Why? Because at the time it started to trend down, look where the 50-day moving average was. We're still below. For a short, we need the 50-day moving average above, right? And then we need the 20 in between and the 9 below. And that doesn't happen to around right where my cursor is. You see where my cursor is? And when that happens, when the 9, the 20, and the 50 line up, we get ourselves a nice short. And that's exactly what happens. So with that, I want everyone to know that if you have any questions on this presentation, feel free to DM me.
And again, I know that was somewhat complicated if you're new. I think a good way to look at this, and it will be explained more in the next video when we talk about the long and strong and the short and weak strategy, is think of the triple moving averages as that twig analogy. You get the bunched up moving averages together. Okay, it helps knowing which direction they are in, because that will give you a more powerful trend. But you can start out very basic. Think of a stock that's consolidating with the moving averages together, and you're waiting for a break above consolidation or below consolidation. Now, that's a very basic triple moving averages strategy with training wheels on, okay, versus what we just went over. But in this market of late, right, this video was made a couple of months ago. In this market of late, okay, just having those bunched up moving averages consolidated midday and then breaking out have been very, very, very strong plays. So keep that in the back of your mind. So let's take a look at what we will be reviewing for our last video and strategy of the day. And I don't think we have a video, so we're going to have to discuss long and strong. I'll put up some writing that I had on it, but better yet, let's just look at long and strong visually. So with a long and strong strategy, let me get some documents here for you to read. And I'm actually pulling it directly from our chat room. So let's take a look. As you can see, what is a long and strong afternoon scan concept? All right. We're going to be reviewing the current long and strong scan, even though it's only 11:30 in the morning now. But let's read through this first. All right. We are looking for stocks that have been trending up all morning for long and strong. Vice versa for short and weak. Short and weak will be stocks that are trending down all day. We know that come around lunchtime, those trend trades kind of give up their gains around lunchtime. But what we're looking for, or the scan will alert us to, are stocks that are not giving up all of their gains, that are simply slowing down and starting to consolidate through lunchtime, which means it's very possible they're going to be good continuation afternoon trades. So for those who have maybe missed out on a 9 EMA long in the morning, they're going to get an opportunity once it starts consolidating through lunch to possibly enter it long again as a second trade, or get in it for the first time since they missed it in the afternoon. The idea is to find stocks that during lunchtime are consolidating in price along the 9 EMA and 20 SMA levels. We wait then until volume picks up in such a consolidating stock. That is criteria 1, right? When I use the term consolidated during lunch, it simply means volumes are usually lighter during lunch and the stock momentum slows down. But even if during lunch, the volume was to start picking up, we can consider actually entering it during the lunchtime hours. The majority of stocks, the volume won't pick up though until after lunch, which is usually around 1:45 p.m. Eastern time. And then those stocks that are consolidating, that now start to see an increase in volume, then we wait for a slight break above those bunched up moving averages we talked about, and we can get in as a long trade. We like the SPY to be trending in the same direction. In this market of late, I must have the SPY trending in the same direction. We also make sure RSI is above, say, 70 or 75, and we check to make sure no upcoming resistance is on a 5-minute or the daily chart, as we discussed in some of the earlier videos. So always understand, look left on both the intraday chart and look left on your daily chart to make sure there's no resistance coming up. And as mentioned, we can enter during lunch hours if the volume trend is picking up in the stock, but we do prefer after lunch. Our stops would be right below the 9 EMA or the 20 EMA if they are close together at the same time of our entry. We want those small losses. And obviously, as always, we prefer our entry price to be right above the 9 or 20 level. We let the 5-minute candle on the chart close first before we decide to exit on a stop, as always. Unless, of course, the stock is tanking, then we use common sense and get the heck out of it. So let's take a look at some possible long and strong afternoon scans. And then the flip to that would be short and weak. So let's take a look. If we have any appearing. And I think I have these scans. Long and strong. And flipped weak and short. So let's take a look at what the SPY is doing. Now, I do not play these usually till around 1:45 in the afternoon. And right now, for the sake of those of you listening to this video on recording, it's 11:30. So we're right before lunch when these stocks should start to slow down. These stocks should start to be consolidating. So let's take a look. We look at the SPY and we see that the SPY has been trending up today, okay, from the morning lows. So we have a SPY market that's trending up. So let's look at FSL. And FSL is a good example. A stock, it doesn't necessarily have to be super clean trending up in the morning, just that it's trending up. And then we're looking for, is it consolidating through lunch? And it very well could be consolidating through lunch. So we do look, okay, for the long and strong scan, stocks trending up, consolidating through lunch, and then we get a break above the high of the day, which is right around here. What keys do we need to have? We need to make sure RSI is not above 70, 75. It is not. We want to make sure, okay, that volume is, or the lunchtime period is over. Lunchtime period is not over, but we'll consider trading the stock if it's showing volume increasing. We look at volume and we actually see the volume going down. So this would not be a trade. The only time we would consider this trade is if the volume was starting going back up and the SPY also was going up with it, which it is at this time. So this would be no trade at this time. But again, at the time of this recording, it's right before lunch. We don't like to play them during lunch because we realize most of the time volumes are down until after lunch. Volume will start picking up around 1:45. So FSL continues to consolidate through lunch. In this pattern, volume picks up. This becomes a long play for us. And hopefully that makes sense. Same thing with Ballard Power System, BLTP. Trends up in the morning. It's appearing on a long and strong afternoon scan. It's consolidating. We wait for volume starts picking up. We make sure RSI is not above 70, 75, which it isn't. And the SPY is trending up. Ballard can become a good afternoon play for us if volume kicks in. And usually that will be after the lunchtime hours. So now today with the SPY trending up, we don't expect to see a lot of short and weak alerts, but we do see a few. Okay, we see INDO, which I believe we had an SMB alert on earlier. It's a mess. I see nothing I like about IDNO as far as a morning trend. Remember, for the long and strong and short and weak, we want to see a morning trend continue after consolidation in the afternoon. We really don't see a morning trend.
Let's look at KGC. Now KGC, we see a good morning trend, short. We see consolidation happening, but look what's happening now. It is breaking above the 9 and the 20. We're not interested in this. It is breaking out of consolidation, not to continue short, but to continue up or go up. And it could be because the SPY is going up. Okay, although this is a gold company, I won't get involved in what possible reason why it's going up, other than it is not giving us a look. We want to see a break down. Let's look at GDYN. All right, GDYN is an interesting stock. It is going down to 9, trending down to 9 the entire day. It is appearing on the flip short and week scan. What we look for in RSI is above 20 for shorts. So above 20 in shorts on a short and week afternoon scan play. Just like we look at 75 and above for the longs. We look for 20, 25 for the shorts above it. So this is below 17, which tells me as we enter into lunchtime, this stock very well can pull back or consolidate, which we want. We want to see this stock now as we're entering lunchtime consolidate. RSI will come back up and then the stock continues to trend down after lunch. So hopefully that makes sense. I know many of you in the room understand a long and strong play, but let me just repeat it in a nutshell. You're looking for stocks for a long and strong that are trending up during the day, that are consolidating during lunchtime, that break out of consolidations in the afternoon based on volume and based on their RSI being under 75. All right, that mirroring the SPY. The SPY is going up with it, or the market's going up with it. On the flip side, on the short and week scan, we're looking for stocks that are trending short the entire morning, that are consolidating through lunchtime, that will break again low in the afternoon after lunch based on RSI being above 20. So hopefully that makes sense. Hopefully that makes sense for each and every one of you. So that is going to be it. I know it was a long session, almost 3 hours. Hopefully the team has gotten something out of it. I think this will be an excellent video to replay over and over again. And the key thing to understand is that we are looking for, more so, we're looking for concepts than we're looking for just blindly following these strategies. And hopefully you can see how one setup strategy in my playbook kind of leads into another and could possibly lead into ones that you are developing for your own playbook. Now, I am going to continue to record because I want those of you who have not watched the if-then statement video and creating your playbook, and a lot of you again are not in our room, so you might want to watch this upcoming video. I am going to end the session by playing my video I created on if-then statements and creating your playbook. It is based on the training that SMB Capital gives to their trainees. So it's very key to understand how to develop your playbook and all that good stuff. Now, what you just saw actually pop up on my screen is price alerts. I have price alerts that are getting triggered real time. And that will be a topic of another training video to do how I create my price alerts. But right now, I am trying to get the video called if-then statements and creating the playbook. So we can watch it and then we'll end the session after that. Most of you is in the room. Bear with me. We will be screen sharing the trade idea scans right after this if-then playbook is done. And we're done for the day as far as the educational session. But this video is 20 minutes long. Please, there'll be a recording of replay of the session that you will receive. I know it's been long and a lot of you might be tired of hearing my voice. I understand that, but please, at some point in the future, watch this video. I think this is probably the most important video that you can watch or important segment of this video that we have created going over today that you can watch is probably this segment right now.
Hey everyone, it's Steve again, and today's video lesson I'm very excited about. It's something that changed the course of how I saw the market. Being a former competitive athlete growing up, the concept of having a playbook in trading really excited me because in sports and with sports teams, most athletes have a playbook that they study and they use for success. Uh, so what prompted me to look more into it was a great book that I read called The Playbook, an insider's look at how professional traders think by Mike Bellafiore at S&B Capital. The book came out several years ago, and it is pretty much the Bible on how they train their prop traders at S&B. But let's talk a little bit about if-then statements. And if you look on the screen, I actually had it typed wrong. There you go. If-then statements and your playbook. How serious of a trader are you? Okay, so let's really discuss what exactly an if-then statement is. For each trade, or prior to entering each trade, you must have a plan for each possible price action scenario. Often, folks will go into a trade without any plan at all, or their plan might be, well, I see resistance $1 away, so my target is $1 away, and I'm going to stay in this trade no matter what until $1. Okay, and that's their plan. All right, and they're not accounting for so many different aspects of price action that can happen along the way, and they get caught off guard and they don't know what to do. All right, so what an if-then statement is prior to entering the trade is coming up with an action plan for every price action scenario that will take place, so you are not caught off guard, that you actually know what and where you're going to be doing something. If the stock is going good for you, if the stock is going bad for you, the price action, or if it's going good and then it starts going bad, how you react. So an if-then statement is really this simple. If the stock or price action does this, then I am doing that. And I'll repeat, if the price is doing this, then I am doing that. It sounds very simple, but for each trade, you can have 2, 3, 4, 5 different if-then statements based on the trading strategy that you're using. And that's another key concept, okay? We do not trade stocks. We trade setups, or more importantly, we trade stock strategies. So strategies that work, not stocks. So often I see new members in our room. When I ask them, what is your strategy for this trade that you are in? They cannot answer. They have no strategy. They just think the stock's going to be going up, all right, based on a silly cup and handle, chart padding or something. The stock's been going up and I want to get in on the move. It's spiking. That's not a strategy. So when I ask them, what is your strategy? Then I ask them, what are you going to do if the price does this? And they don't know. Okay. And that's being totally unprepared. It's like a football team having no playbook and just going out there and drawing plays up in the sand, in the dirt at a professional level. And they're not going to be able to compete. Okay, they cannot compete because they're playing against other professionals that have if-then statements already established. And let's face it, in this day and age, the opposite end of your trades are machines, right? 90%, whatever the figure is, And those if-then statements are algorithms. In fact, if you look under the definitions of artificial intelligence as well as algorithmic trading, you'll see if-then including in the definitions because that's how they are programmed. If it does this, then I do that. If it does this, then I do that. All right, so it's very important for new traders to start developing if-then statements and then adding them to their playbook, which we'll discuss shortly. Okay. You know, and then if-then statements are not just made up on the fly as you go or trade. They are part of a pre-existing trading strategy you have in your playbook to use. So your if-then statements should already be in your mind. You know exactly what they're going to be, okay, prior to entering the trade, and that's based on the strategy that you use. So let's take an example of one of my if-then statements, because that might be a little bit easier for me to explain, okay? Most of you in the room are very familiar with what we call the projectile long to VWAP strategy. Okay, I use it, Ray uses it, Greg uses it, several folks in the room uses this strategy. Okay, if you do not know what the projectile long strategy is, there is a video on it in the day trading training vault strategy room. So take a look at it. But you don't need to know the specifics to understand how I'm using an if-then statement for the projectile long strategy. And this is what I have in my mind prior. Now, Ray, Greg, and other folks might have different if-then statements for the projectile long strategy, but that's because every individual has a different trading strategy, a different trading style or thesis, and that's okay. So what I'm talking about here is what I use as if-then statements for the projectile long strategy. So for me, if the price breaks above the 9 EMA and the SMA, 20 SMA, then I will enter long with my stop right underneath the 9 to 20 for a low risk exit. Notice again, if price breaks above, then I will do this, okay? That's one. Let's look at two, same trade. If price falls below the 920, then I will exit with a small loss. Again, if the trade does not go my way, then I will exit for a small loss per the strategy. Three, again, same trade prior to entering that same trade. Three, if price rises halfway to VWAP, which is a strategy, but then starts to stall, then I will sell half shares to lock in profits. Again, if price rises halfway, then I will do this. Okay. Four, if price continues to stall or even pulls back, then I will sell remaining shares to lock in profits. Again, if price does this, then I do that. Five, if price rises to VWAP, which is my strategy target, then I will sell all shares. So if the price rises to VWAP, then I will sell all shares. So for that one strategy, projectile long to VWAP strategy, I have 5 different if-then statements that I use, okay, for my trade. So that's an example, okay? And I have if-then statements for all my trading strategy. Now, like anything else, okay, I'm constantly keeping my eye on the market and how conditions and strategies work, which means these 5 bullet points, okay, can be changed only if the market action starts to dictate it on a repeating behavior. And often I can pick that up on some back testing that I do. So that's a good example of an if-then statement. So if we are trading in the trading room and you're in the trade and I ask you to give me your if-then statements, you should be able to rattle off more than 1 or 2. You should have every case covered. Okay, let's go to the next slide. You trade strategies, not stocks. I cannot tell you how individuals just go into stocks and they have no idea what they're doing in the trade. Okay, they have what strategy is, they have no idea what your strategy is. All right. If then statements should cover the potential of when strategy fails also. So you have every scenario covered what price will do. Okay, I cannot repeat that. If then statements are not just statements for when the stock does what you expect it or want it to do. It's to cover every scenario. Okay, and if you are in a stock or you are in a trade and you are hoping price does this, or you're thinking price is going to go to this level, okay, hope and thinking are not trading strategies. For the projectile long to VWAP strategy that I just mentioned, I do not hope it goes to VWAP. I do not think it goes to VWAP. I have no idea if it's going to go to VWAP, and all the hoping in the world is not going to help me. I just know that statistically backtesting, it has a possible good chance of reaching VWAP. So it's not what Steve thinks it's going to do, it's what the math's going to think it's going to do. So if you think or you hope, get out of the trade. It's that simple. And you see new traders do that all the time, and they wonder why they can't grow their account, or they wonder why or how they blow up their account. So we've been talking about this playbook. What is your playbook? Do you even have a playbook? All right, you write it down, okay? Put it in, computer form, handwritten form, okay? But how do you create this playbook? Creating this playbook is just not taking Steve's strategies or someone else's strategies or Ray's strategies and then just putting it on paper as your own. No, every trader is different. You can use the concepts of the strategies we use to form your own playbook, okay? So you need to ask yourself, at the end of each day, what trading setup made the most sense to you during the trading day? Think about that. What trades have you been in, okay, that made the most sense to you? Now, making the most sense isn't, well, I just profited real big because the stock went from $1 to $5 and I got lucky in it. That's not making sense. Making sense is seeing the price action, seeing how the stock's set up, and then you getting a form of that pattern in your mind as something that if you see again, you might want to consider trading. So ask yourself that at the end of each day, was there any trading pattern that made sense to you? Okay? Any. It could be mine, it could be someone else's strategy, and I do it all the time, even with new traders. New traders will post a trade, and I'll look at it and I say, wow, that trading setup makes sense to me. I could care less if they've been trading, 1 day, 5 years, 20 years. If there's a trading setup out there and it makes sense to me, I'm going to look into it, add it to my playbook, and dive deeper into it to see if I want to keep it in my playbook. That's why you hear me constantly encouraging people, even if they're new, post your trades, okay? All right, it helps other people, and it could help us now take this to the next level and help you develop your playbook, okay? So at the end of each day, what trading setup, your own or someone else's, that makes sense to you, and write it down. Get that in your playbook, all right? And then, has this trading setup been successful for you? Are you starting to see that it's just not one time it's been successful, but it's been multiple times it's been successful? Okay. Then you definitely want to add that to your playbook, that strategy. So when you see that setup again, you consider entering it. Okay. With your if then statement. So in your playbook, would you not only put the strategy, okay, that you found, but you also then put some if then statements behind it. Okay, so your playbook would have the strategy as well as your if then statements for that strategy. Okay, so let's take a look at the next slides. Exercise your brain for winning setup. So Steve, I don't want to do a playbook. I don't need to do the playbook. I have it up in my mind already. Well, no, what we're saying, like a professional athlete needs to study his playbook in writing, okay? By creating a playbook that highlights your successful trades and strategies, it brands your trading brain to synthesize the most important market patterns for you to study, okay? That's a fancy sentence, but all it means is you're building your muscle memory. Okay, by studying it over and over. And by studying it over and over, you're developing more screen time. You know, people talk about, well, I've only been trading 1 year versus I've been trading 20 years. Well, you know, if you're trading 1 year, but you're putting in the time, the effort, studying your playbook, you're getting a lot more screen time than, say, someone that already has 3 years worth of trading. So you can accelerate your learning curve and your experience by studying your playbook. Okay. Reviewing your playbook and studying it like an athlete does, you instinctively begin to spot them real time. You don't have to think about it. You'll start seeing these setups. There's no real-time thought or hesitation for your A-plus trades, okay? And in your playbook, you will have A-plus trades. You'll start to learn the difference between your A-plus setups versus lesser setups, okay? Your A-plus setups are those setups you know that when you see them, man, okay, these are normally successful trading setups for me. And you tend to then should go in with higher share size. Like for myself, on my A-plus, shares setups, I'll go heavier on my shares, all right? Because I know statistically, I have a better chance of winning that trade. Versus my other trades, I might go lighter in share size, okay? And that's based on understanding from my playbook, which are my stronger plays and which are my weaker plays. Just like a professional sports team will have a ton of plays in their playbook, but they might only have a handful that they consider really strong plays that they'll use at certain points in certain games, okay? And it's no different with your trading playbook, okay? Let's look at a recommended reading because we can go through a presentation, but there is nothing like actually reading a book about this topic. And it's called The Playbook by Mike Bellafiore, okay? Your playbook is a series of archive trade setups that make the most sense to you. Not what makes the most sense to me, that's my playbook, but what makes the most sense to you, okay? The idea is for you to build from your strengths, the plays in your playbook, and minimize your weakness, anything not in your playbook. Meaning you shouldn't be trading anything that's not in your playbook. And everything in your playbook should have if-then statements. You then, eventually when you start developing a playbook and you're getting confident, you start to break down a bunch of market and data on your trades, and you start creating these A-plus statistical setups by back testing them, by back testing your strategies, by going out, because now you're serious about your trading. Now you want to continue to do it. You put some time into trading. You like it. You're getting some success manually creating your playbook. But now you want to take it to the next level, and you get software like the Trade Ideas software we use, and you start learning how to back test. With software like Trade Ideas we use, you don't need to be a coder because it comes preset filters that's used in very basic English language, not coding language, but you can backtest and create and code your own scans based on your playbook, your setups, your strengths, and eliminate your weaknesses. And before anyone goes rushing out to get trade ideas, we do Zoom screen share it, but it's only a fraction, okay, of the potential trade ideas has. And what we Zoom screen share is pretty much some setups from my playbook, not yours. So when you are ready, you can contact me directly because I can get you a much better price on trade ideas than going directly to them, because we have a personal and a business relationship with the good folks over there. So you just simply direct message me. But eventually, if you are dead serious about your trading, you're going to need to get it. And it's really not expensive. I think I can get you a deal where it might be $100 per month or a little over $100. So it really, you could, the cost of it in one trade per month easily. And those in our room that are using it swear by it. But this isn't a trade idea sales pitch. It's also letting you know that you need the latest technology, because the folks on the other opposite end of your trades are using that automation to create their if-then statements that they are trading against you. And a lot of those folks obviously are institutions and machine driven. So I recommend the playbook by Mike Bellafiore. It goes into these concepts in much deeper detail, but I think from this presentation I just gave, you can get started on creating your playbook. And the best bet is you can ask me questions anytime, direct message me. You can contact me in the rooms. I absolutely do not mind helping you on this concept. So that being said, I hope you guys got something out of this presentation. And if you have any questions, like I mentioned before, simply let me know, and have yourself a great day, guys. Thanks.